You can do it from Coimbatore, you can do it from Bangalore, or you can do it online from all over India. This is the course. For more details, right, we will be releasing more videos on.
Okay. Okay, so yesterday we covered till ADRs, American Depository Receipts. So in the long-term financial management only, we need to start with calculation of value of share. So debt financing and the cost of debt is done. I mean, like, to calculate how the market value of the debt and the cost of debt. So what is the formula of cost of debt? Yes, cost of debt formula. So in the debt, what is the cost? Interest. So interest is a cost, and what we have to minus? 1 minus tax rate is equal to cost of debt you will get. Okay, so this comes to your numerator, and denominator would be market value of bond. Okay, now we'll calculate the value of the share. So to calculate the value of the fair value of the share, yes, so it's simply as the present value of all the future cash receipt to be received from that share. So present value of all the future cash flow, the same with the market bond value we created, right? For the bond, what we did, we calculated the interest and we converted into present value by using what rate? By using the market rate, right? So same way here also we'll convert present value of all the future cash flow to be received from that share, discounted at investor required rate of return. Discounted at investor required rate of return. Whatever I require, whatever the investor required rate of return, based on that amount I'll convert it to the present value. Okay, so in this example it says, suppose if a person is holding a stock price is $10. A person is thinking that it will go to $11, then he will wait till $11, then he will sell. What if a person is thinking that it is only worth $9, so he will sell it today, because holding that is not giving any gain to him, because as per his point of view, as per his required rate of return, he is happy with the current price, so he will sell it. Okay, this is how the stock market works. Suppose you feel that the price will go up, will you sell it or will you hold it? What you will do? You will hold it. And whenever you feel, yeah, this price is, the current market price is worth more than what its value, then what you'll do? You will sell it off. Okay, so the stock intrinsic value or the stock value is based on cash generating ability, that is present value of all the future cash flow. So what required rate of, like, what is the discount rate we have to use? We have to use the required rate of return appropriate for the risk involved. Okay, so investor might be having a certain required rate of return, so based on that required rate of return we'll discount the future cash flow. Okay, so there are a lot of techniques to be used, there are a lot of models in this, but the baseline what I want to inform is, just take the cash flow, convert into today's value. So now what and all cash flow can be received in stock? Because whenever you buy bond, suppose if you are investing in bond, what you will get? You will get the interest, and at the maturity period you will get your amount. If you buy the stock, what you gonna get? Monthly or yearly, quarterly, what you gonna get? You will get the dividend. So this is the cash flow in the stock. And suppose if you have a certain period that I will hold for only 5 years, 4 years, or 10 years, certain amount you will be having in mind, right? Yeah, so the selling price of the stock, for what I will sell, that is one. So one is dividend you will gonna get, and sales price of the stock. You take this two amount, convert into present value, you got the share value for today. That's it. So the idea of this, all these 7 models, whatever the 7 models is this, the base is this: take the cash flow, convert into present value. And what if I want, because bond there is some maturity date that we have certain period, we'll sit and calculate, but a stock does have any maturity date? No maturity date. So sometimes we might be not having any intention to sell, no any amount. So then what you will do? Then take only dividend and we're gonna find the present value of the stock. So we have 7 models in this, but few models are again a repeated version of that only. So the first one is zero growth model. A zero growth model, it says the dividend what I gonna get, it is constant, it doesn't grow. First model is a dividend doesn't grow. A second model is a dividend have a constant growth. A dividend is having a constant growth. And the third model, dividend plus expected future stock price can be used when the next dividend is given. No growth in the dividend is expected, but an expected stock price at the end of the year is given. Here dividend and expected future stock price is given. It's simple as that. The one which we did for the bond, right? The same which we're gonna use for this third model. And CAPM, you already know. Okay, two-stage dividend discount model. Yes, here this the fifth one. This one is little bit complicated. I mean, little bit tricky. So what you gonna do? Like till certain year, the dividend is the dividend growth might be like 5%. Assume that 5% or 12%. It's keep on growing, but after that it is changing. It is changing to 5% for infinity. So that is called as two-stage dividend discount model. Next, it's also same as the bond, present value of future cash flow, and relatable and comparable valuation model. This one is little bit odd. The 7th one is little bit different. Here we don't use the present value of cash flow model. Which one? On the 7th one. Rest all this 6, right? It's similar as that. Okay. Now first we'll go check for a zero growth model. So when you buy a stock, what you're gonna get? You're gonna get the dividend. And if you're predicting that the dividend is not going to grow, example for the preferred share, the dividend is constant, right? Because it says 5% preferred share for at $10,000 or $100,000. That because in the preferred share, what is constant? Dividend. This is usually used for the preferred share, but if you want, you can use for the common share. There is no harm in it. So this says the dividend is growing. Sorry, the dividend doesn't grow here. Zero growth model. So what you're gonna do is you can use this formula. Whatever the dividend you have, you take it because it doesn't grow. So the dividend is constant. This year, next year, coming year, the dividend is same. Take the dividend divided by required rate of return. What is the required rate of return of yours? You divide by it, you will get the present value of that share. I mean, that is the price of the share. That is the value of the share according to you. That is the intrinsic value of the share. Okay, clear with this? Example, a preferred share pays an annual dividend of 4% of $25. So what is 4% of $25? It is $1 per year. How much you're gonna get? You're gonna get $1 per year. And the required rate of return is 5%. So what you'll do? What is the annual dividend? 1. Required rate of return 0.05. So then what is the present value? 20. So you say, I'm ready to pay. The investor say, I'm ready to pay how much? $20 for this share, not more than that. Okay. Suppose if we change this, what if the investor required rate of return decreased to 4%? What was his investor required rate of return? 5. Now it decreased to 4. You guys know that numerator and denominator, how does it work? Now what happened to the denominator? Denominator decreased. When the denominator decrease, what will happen to the value? Value will increase. So same here as that, 1 divided by 0.04. So it says the present value of the share is how much? $25. Because now the investor require only 4%. If it was 5%, he is ready to pay only how much? 20. Now he require only 4. So he is ready to pay how much? $25. Clear with this formula? Any doubts on this? See what, like each model right now we are keep on building. So if you understand this, next formula just will add one extra thing. That's it. So this is when we can use when there is zero growth on the dividend. Now the investor is expecting growing dividend. What is expecting? A growing dividend. So when the growing dividend, if you're taking the numerator, it have a slight different. Just check this. What is the numerator is having? Next annual dividend. So it doesn't say it says annual dividend, but this one says what? Next annual dividend. So what you have to take? So example, this year company paid $4 as a dividend and growth rate is 5%. Okay, this year what, how much the company paid? $4. And what is the growth rate the company is expecting? 5%. Now tell me what could be, what it should be my numerator. Is it $4? Yes, is it $4? What should be my numerator? Why 4.2? Because here it says what? Paid. Paid means the company already paid for this year. But what is the numerator here? It says next annual dividend. Next year, what I'm expecting. So that should be the numerator. Okay. So you should take what? D1. D1 means dividend on the first year. Dividend on the next year is what we have to take. So you have to take the next annual dividend. Now we'll come to the denominator. It's same as that. Investor required rate of return. But one thing you have to minus is G. Like growth. So I can write like this. D1 divided by R minus G is equal to P0. Clear with this? Is any doubts? Just you have to add what? G. Now whenever you minus, what happened to the denominator? Denominator will go down. But as we denominator go down, what happened to the, it will increase. Here is a short form. D1 divided by R minus G. So what is dividend? D1? D1 means the dividend for the next year. So for sure they will gonna confuse you. They will give this year dividend. So you have to convert whenever you use in the formula, convert it into the D1. Okay. So we will see this example. A common share paid. What does it say? Paid. An annual dividend last year, how much they paid? $1.1. And the dividend is going by 5%. And what is the required rate of return? Okay. So yeah, investor required rate of return is 12%. So now, do I need to take 1.1 on the numerator? What should be my numerator now? Guys, is it 1.1? How much I have to take? Much? 1.122. So if you want a formula, so D1 is equal to D0 into 1 plus G. So G means growth. So what is D0 here? 1.1. 1 you keep as a constant. G means 0.05. If you do this, you will get your D1. So your D1 is 1.155. And denominator is what? R minus G. What is your R? 12. G? 5. So 12 minus 5, 7. So 0.07. So the price he is ready to pay is how much? $16.50. Now what if the required rate of return is increased to 15%? If the investor required rate of return is increased to 15%, the intrinsic value of the share will decrease to 11.55. Clear with this? Whenever my required rate is increasing, guys, you want more than earlier. That means you are ready to pay lesser now. I'm not ready to pay more because I'm expecting more. So I'm ready to pay less. Clear with this? With growth model. Okay. Now the third one is where things will get complicated, which is called as two-stage dividend discount model. So in this two-stage dividend discount model, as the name says, we'll cover this as a two stages. One, where it says till this year the dividend will be growing this much. After that, that will going to be constant. Constant as this second one. The second one is there, right? This one. Okay. So till certain year, the dividend will grow this rate. After that, the dividend will be growing in a different rate. So same as that, we also need to break this into two format. So first format is what? So during this phase, the company is rapidly growing like 20% for the next 3 years as an example. So we'll do this within an example directly. Okay. So we can take example. I'll check if I have any example. Year 1, 2, 3, or if I want to tell, year 1 dividend is $1. Year 1, the dividend paid is year 1, the dividend is $1, and it is growing by 20% till next 3 years. I mean, till 3 years, the dividend is growing by 20%, and after that, it is constant 7%, and after that, it is constant. The dividend is growing by how much? 7%. Required rate of return, you take it as 14%. Okay. Now, what is the year 1 dividend he is paying? $1. Okay. It is not paid. I already converted into year 1, dividend 1. So no need to convert it again. So understand that whenever they give dividend paid, then you make it to D1. Now this is already D1. So year 1 dividend is how much? $1. Now till 3 years. Year 1, year 2, year 3. I mean, like from till third year, the dividend is growing by 20%. So what would be the next year dividend? 1.2. And after that, 1.44. Clear? And I'll write this separately. And what could be the fourth year dividend? 1.54. Why 1.54 on the fourth year? Because after third year, the dividend is growing by how much? 7%. So this one I'll write it out because from here onwards, the dividend is going to be constant from the fourth year. So till third year, what is there? There is certain dividend, 1.2, 1.4. That period is there, right? The initial period, we have to write it separately and we have to convert into present value. Normally you do the present value, right? By using what rate you have to do? By using 14% you do it. Yeah, we'll start doing this into the present value. How much it is? 0.87. Tell me at least two numbers. 877, 0.9233. Next, 0.97. Sum it up. 2.7723. So the first stage is done. So here I'll mark this as 1. Okay, I'll mark this as 1. Let me keep it here. Till here, is it clear? Till this, because it is easy as that. First, what they told, it is growing by how much? 20%. So I calculated for the 20% for the 3 years. Then sorted. You have your 3 years discounted cash flow also. So this is 2.773 is what? This is the present value of future cash flow. And from the fourth year, the dividend is growing by for how many percentage? It is growing by 7%. So I made it 1.44 into 1.54. So this dividend is for 4th year. So it will be what? D4. Correct? If this is D4, what I can get here? Price of the stock after the 3rd year I can get. We'll use D1. Then what I'll get? P0. Today's stock price I'll get. If I'm using D4, what I'll get? The price of the stock after 3 years, not today. Understand that this price is not today's price. This is after 3rd year. So D4. And from here, the dividend is what? Constant, right? So we can use this formula. D1 R minus G. So same way, here we use D4 R minus G. So how much is your D4? 1.54. And what is your R? 0.14. And what is your G? 0.07. So now what is their P3? 22. So this is a present value of sorry, not the present value. This is a price of stock on the 3rd year. Now, is this price are you getting today? Are you getting this $22 today? No. This stock price is when? After 3rd year. So what do you have to do now? We all know that this is after 3 years, means now we have to convert into present value. So you take the discounting factor and convert into present value. So again, 1 divided by 1.14 3 times. Don't do 4 times because it's 3rd year. Don't get confused that. It's a price 3 means after 3 years you are getting. No, 22 you convert into present value. 14.8 of 4, right? Okay. This is 2. Now I have written 1 here, 2 here. Add this both. You will get the present value of today. You will get what? The stock's today's value. This is for 3 years. This is a cash flow. And this is the infinity cash flow. So infinity one you converted into today's rate. And the 3 years cash flow you converted into today's rate. So approximately it stand around $17. So that $17 is a stock price. This is the stock price of that. Sorry, this is the price of the stock. 17.6. Okay, clear with this? So first step was first we have to find the dividend of what? Of the particular year they have mentioned where the dividend is growing. Then what you have to do? You convert that into present value, keep it aside. Stage 1 is done. Now stage 2 is what? Stage 2, you just do this D4 or D5, whatever the next year dividend. From there it is going to be infinity. So then you use the D4 or D5. Here in our example was D4. So we converted that into the present value again. So we'll get the price, and the price is not today's price. So again you have to convert that price into present value. So that present value plus the dividend you are going to get in the next 3 years, you add it up, you will get this. So this is the formula. Present value of stage 1 dividend, the one which we got $2, and the present value of stage 2 terminal value. The present value of the price of the stock you convert into present value. You will get what? Stock value for the today. Clear with this? So this is the one which is a complicated one in this all model. So if you know first and second, the third one is going to be easy as that. Okay, and you all know how to discount the cash flow. Okay, done. Next is fourth one, valuing common stock using dividend plus expected future stock price. What they gave for the 1 year. This is for the 1 year. They have given what? Dividend after 1 year and the stock price after 1 year. Example, after 1 year I am going to get $4 dividend, and the stock, if I sell after 1 year, it is $25. When I'm going to get this? After 1 year, right? If I'm getting after 1 year, means what do we have to do now? Convert into present value. You will get what? P0. Simple as that. So see here, P0, today's value is equal to D1 plus P1, price after 1 year. 1 plus R. The 1 plus R, you know, right? 1 divided by, so same that one only. Okay. Clear? If you want to try, you can try this. Like suppose if there will be an expected rate of return, using that 29 divided by 1.14 you will get the P0. Next is CAPM model. As yesterday only we finished the CAPM model with the dividend growth model and valuing stock. Suppose in some question, if they are not giving the R, in all the question we saw in the growth model, without growth model, double growth model, there is R, right? If they give R, well and good. Suppose if they are not giving the R and they are giving these sort of information, means we have to first, what we have to do? We have to go and find the R and come back. So for that, we use this formula. R is equal to RF plus beta into RM minus RF. Now what is this called as? Yes. No, I mean not RM minus RF, the total purple color. Security, security premium. And what is only RM minus RF called as? Market risk premium. Okay, market risk premium multiplied by your company beta, you will get what? Security, your company's premium. Then I'm not happy only with the premium, I want risk free rate also. Then I'll get the R. You take this as an example. We'll try this. So the company beta is how much? 0.8. Yesterday I told, right, if the beta is lesser than 1, you are happy with lesser return than the market. So the risk free rate is 0.5. The expected rate of return of the market is 5. So whenever the market rate is, like here the market rate is 5 and the beta is 0.8. So how much you could be your R? Your R is more than 5 or lesser than 5? It will be lesser than 5. Why it is lesser than 5? Because your beta is lesser than 1. Market beta is how much? 1. And your beta is lesser than 1 means you are less riskier than the market. If you are less riskier than the market, you can't charge more premium because market is giving more than that. So higher the beta, higher the risk. That you understood, right? So now 0.8 is lesser than 1. So we are less riskier than the market. So we expect more than that. And dividends are going to be 2% per year. So they have not given the R. So our first job is to find the R. So how to find the R? Risk-free rate, you keep it RM minus RF. How much you will get? 4.5. 4.5 into 0.8 plus 0.05. You will get 4.1% as your R. Now you have your R and you have your G. So R minus G, you will put it here. And if the dividend is 1.02, so 1.02 divided by R minus G, 48.57 is your stock intrinsic value. Clear with this? When there is, if R is not given, we have to use CAPM model and find it. Next, guys, present value of expected future cash flow. So yeah, this is same again as that. Suppose example, a person have invested in A Limited and expected the following dividend. He is expecting the following dividend 1, 2, 3, 4 and following dividend and terminal value of the share. Year 1 is expected 10, 18, 22 and at last he expected $15 plus $125. He's planning to sell this. and the investor required rate of return. See, these are the amount he is going to get. These are the amount he is going to get. And the investor tells, I require 10%. What is his required rate of return? Required rate of return is 10%. Now then find the selling price of the stock. Find the today's value of the stock. So try this. So what would be the selling price of the stock? A person is investing in A Limited and he is expecting these dividend, and at last he is expecting what? The price of the stock is going to be 125 after 4 years. How much I am ready to pay for today? How much I am ready to pay today? After 1 year. If it is year 1 means after 1 year. Year 0 means today. Year 1 means after 1 year you are going to get $10. Try this fast. Use the 10% and try to convert this. So as universal formula, 1 divided by 1 plus R into N multiplied by cash flow is equal to present value. Try with this. How much it is? 136. Everyone got the same? 136. Okay. So just convert into present value. So what is the present value of this? 10. So it will be 9. 1 divided by 1.1. So it is 9.090. 1 divided by 1.1 into 18. 14.876. See here I am receiving 15 and 25. So I can tell after 4 years I am going to receive how much? $15 dividend plus I'll be selling the stock for $125. So I'll be getting $140. 4 into 140. 95.621. Sum it up. 9.090. 14.876. 16.52. 94.621. 136.107. Clear? Everyone got the same? Any doubts on this? Easy as that. Done with this. Next, this last one, relative or comparable valuation model. It is a little bit different. When you don't have the cash flow, when you don't know all this, when you are a startup firm or something, we use these methods to calculate the stock price. So what is it like? As an example, like you compare yourself with some other company. So other company is valuing this. So you can also value the same and you will sell. That is the reason name as a relative or comparable valuation model. You're doing a business and next to your business, there is other person also doing a business. So whatever his valuation is, you are matching it. Okay. But the catch here it is, suppose this guy is less risky and you are more riskier. So investor will expect same required rate of return or more required rate of return. More. Why? Because you are more riskier than him. So whenever you compare, you have to adjust with what? Adjust with risk. Example, you're running a fast food restaurant and there is a McD also. So yours is a small fast food shop and here it is a McD. So McD is telling he is valued at $1 million. So can you keep the same valuation for you? Is investors are ready to pay 1 million for you? No. If they have money, because McDonald's is more safer than your fast food restaurant, so what they're gonna do? They will invest here. So what you have to do is you have to adjust your company valuation by what? By risk. Using the risk, you have to adjust your company's valuation. Clear as that? Okay. Now we'll look into this example. So we can use all these formulas to calculate what? The company's value today. So one is what? By using PE ratio. So PE ratio into earning per share of the company. See example, privately held NMP corporation earning per share is $3. What is our earning per share? $3. After reviewing the PE ratio of the public company in the same industry, the analyst determined they sell between 10 to 15 times. So what is the PE ratio of others in the industry? I'm comparing with others. So what is the PE ratio of others? It is between 10 to 15. Thus an appropriate stock price for M&P would be between 30 to 45. How it is? 10 into EPS, it might be 30, or 15 into 3, it might be 45. Or we are telling the risk adjusted PE ratio is 10.7. So we'll take 10.7 into 3 and we'll tell our stock price is how much? $32. Clear with this? So we use this formula to find what? The present value of the company. Or we can take market to book ratio, as this and all is covered in your section A, right? Market to book ratio, PE ratio, EPS, all this. So market to book ratio again will take and multiply by book value per share. Book value per share, how you can calculate? BVPS, equity divided by number of shareholders outstanding. Okay, so that BEPS you will adjust with market to book ratio. Okay, and price to sales ratio, your sales revenue per share, I'll take total sales of my company and divide by what? Number of shareholders. Then I'll get sales revenue per share and multiplied by price to sales ratio. What is a price to earning, as we have did for the price to earning, right? Here we'll do price to sales ratio. So these are like these three formulas is like using a comparable valuation model. Suppose you don't know what is the value of the business, or you have a land or a building, you don't know what is the valuation of that land. So what you'll do, you'll compare with next person land, how much he sold and what is the worth of it. So you will match it with that price by using the market. And suppose if your land is having some risk, is the person is ready to buy for the same price for what he purchased the others, because that your land is more riskier because of some reason, so he'll purchase lesser. So that risk adjust, compare, you can compare and adjust with risk. Clear? So these are the 7 valuation model we use to calculate what? The price of the stock. Clear? So the 3, you can take it as a 4: without growth, with growth, and dual growth, and present value of future cash flow. These are the 4 things which is very important. The rest everything is again convert into present value, convert into present value. Now we understood the current market price of the preferred stock or a common stock. Now we have to understand what? The cost. The cost in the preferred stock is what? Now this is the same valuation model you can use for preferred stock and common stock. There is no any problem with it. Now we'll look into the cost perspective. So what is the cost in the preferred stock? What is the cost in the preferred stock? Dividend. Whatever the dividend they are going to pay, that is a cost in the preferred stock. So for example, if preferred stock par value is $50, what is the par value? 50. And they pay 5% dividend. So the dividend is calculated on what? Preferred stock is dividend is calculated on par value. Bond interest is calculated on par value. So whenever you calculate the interest, calculate on the par value. So 5% annual dividend. So what is this? It will be 2.5 or 5% of 50. It is how much? $2.5 is a dividend, correct? Yeah. So $2.5 is a dividend. So this is how you will calculate on the par value, you will calculate the dividend. So the cost of existing preferred stock. So why here there is a cost of existing preferred stock and the new preferred stock is, suppose if I'm issuing the new preferred stock. So what I have to give is I have to give the floating charges. What is this floating charges is, suppose the stocks are issued to the banks. The bank will come, the bank will help you to issue the stocks. They will do the paperwork, they will help you to get the investors. Suppose if there is any floating charges, so floating charges is also considered as stock, like the cost. So example, I issued a preferred stock for $50. Issuing price is how much? $50. And bank is charging 10% on this. Then how much I'll get? I'll get 55. Why I have to pay 55? No, like I'm a company. I went to bank and told, see, I have this many shares. Please sell it and give. You collect from investor how much? $50. And you take your 10%. And at last company will get how much? 45. So in the 50 you have to minus what? 5. That the 10%. The floating charge you will minus. The amount you will get is you will keep in the denominator. Now this formula you can use if it is used for existing preferred stock. Guys, going forward, whatever the cost will do, at last it will come and sit in the WACC. While calculating the WACC, again this formulas is going to be used. So when it comes to preferred stock, if it is existing, what are you going to use? Numerator. Numerator will be the annual cash flow per share in the form of dividend. I mean the dividend I pay will be in the numerator. And the denominator is what? Current market price of the preferred stock. So yesterday only I told multiple times, we have to use what in the denominator? Market price, not the book value. Don't worry about the book price. Don't worry about the par value when you put in the formula. The par value is just used to calculate your interest and dividend. That's it. The job of the par value is done. You just have to take market value while calculating the cost. So here, the cost of the dividend is how? Annual cash flow divided by current market price. Example, Steel Corporation has how many shares? 28,000 preferred share. Outstanding par value is $100. What is the par value of that share? 100. And the market value is 98. Now tell me, in the formula will you use 98 or will you use 100? Which one will you use? Not for the calculation of dividend. 98. For the cost of the existing preferred stake, to put in the formula, will you use 100 or 98? 98. You will use 98 because that is the market value. And annual dividend of 5% of the par. When you calculate the dividend, you use what? 5% of 98 or 5% of 100? 5% of 100, because the dividend is calculated on the par value and the cost is calculated on market. That's it. So now you're easy as that. So first we'll pay the dividend. What is the dividend? 100, 5%, you pay $5. And what is the market value? 98. So what is the cost of existing preferred stock? So what is the cost we are paying to fund this preferred stock? What is the cost we are paying? So what is the cost we will be paying? 5 divided by 98. 5.0. Multiply by 100. 5.10. So 5.1, which is more than exact 5%. This is for what? Existing. But when it comes to the new preferred stock, one simple thing. The difference is what? Instead of using a standard market price, when we use the standard market price in the denominator, right? You must use what? Net proceed. So in the denominator here, you will be using net proceed. Now, what is this net proceed? So to get the net proceed, you should understand flotation cost. So flotation cost is the fee paid to the investment backer to issue the new share. Okay. This will be the formula of the cost of new preferred share. Cost of new preferred share. So what is the formula? See, again, it is a dividend, and this is what? This is called as net proceed. And how you will get the net proceed? Issuing minus flotation cost. issue price minus flotation cost, you will get the PN. Selling price minus flotation cost. Now see this example. ROG Corporation is going to issue 20,000 share and preferred stock is how much? $50 par value, and the annual dividend is 5% of the par value. Issue price, you see the issue price is how much? $35, and the ROG will incur $3 per share as a flotation cost. What is the flotation cost? $3. For what price I am issuing? 35. Flotation cost is 3. Now what will be your denominator now? What could be your denominator? 35 minus 3. And numerator is same as that. So 5% of the par value. How much it is? 2.5. Now calculate the cost of preferred stock. No. 2.5 divided by 32. So 7.8%. Clear with this? The cost of preferred stock when if it is existing and when it is new. If it is existing, easy as that. Dividend divided by market value of preferred stock. If it is new, dividend divided by net proceed. How to get the net proceed? Issue price minus flotation cost. So the difference between the existing and new is just the denominator. Now we'll see the cost of common equity. The two sources of common equity is one is retained earnings and one is new common stock. Suppose if I am issuing new common stock or if I am okay with the retained earnings. So the cost of retained earning is this. So the cost of retained earnings as a company is not a cash, the cost paid in the form of dividend or interest. So there is a twist with the cost of retained earnings. So usually what is a cost? Cost means either interest or dividend. But here the cost of retained earning to the company is not a cash cost. The cash they actually pay. It paid in the form of dividend or interest. It's not a cash that is paid in the form of dividend or interest. Yesterday I explained you why the cost of capital of equity is very high compared to bonds and preferred shares, because usually we might pay dividend or we might pay not dividend, but who is taking more risk? Common shareholders taking more risk, so we have to pay more return to them. So when they are expecting more return, their expectation is our cost. The investor expectation is our cost. So if they expect high, then the cost is high for us. So rather than the opportunity cost, next best investment was not by the shareholders will be the return. That will be the cost. For example, the company is generating 9% return on asset. How much the company is generating? 9%. Shareholders, other best alternative investment provides 7%. Suppose I am a shareholder. I have an option to invest in other instrument. I am getting how much? 7. But this company is generating how much? 9. See, whatever the company is generating, it's common shareholder. It's mine. Either if they give dividend, if they are not giving dividend also, it's my money is in the company they have retained. So the shareholder will be happy and retain their investment. They will be happy with the 9%, because if I have $100,000, I have an option to invest 7% somewhere, and this company is generating 9%. So what you will do? You will tell them, okay, you keep my investment. What if the company is providing lesser than my opportunity? Suppose I have an option to invest somewhere and I can get 8%, and this company is generating only 5%. Will you keep your money in that company? No, you will take it out. So that's it with the cost of retained earnings. So investor required rate of return. The cost of retained earning is based upon the risk of the firm and the investor required rate of return. So there are two different ways to calculate the cost of retained earnings. So these are the two different ways to calculate cost of retained earnings. See, for the bond and for the preferred stake and all is easy. For the cost of retained earnings, these are the two methods. Clear? So one is what? Dividend growth model. By using the dividend growth model, you have to calculate what? You have to calculate their cost if the dividend is paid. See, in the exam, you will not get this model use, this model use. Take the question, understand which model you have to use. Second one, CAPM. Guys, in CAPM you will get the R, right? R is what? Expectation. Their expectation is our cost. Sorted. CAPM R is our cost of retained earnings. That's it. You already know one model. Now we'll learn what is this dividend growth model. So dividend growth model. The dividend growth model uses what and all? Dividend per share, the expected growth rate, the market price of the share. P0 we used P0. The same formula, rearrange it. You will get this. P0, how to calculate P0 if there is a dividend growth? D1 divided by R minus G. Everything is there. This is R. This is P0. This is G. And this is D1. So if you want to put it, P0 is equal to D1 divided by R minus G. Now here we know what is P0, but we have to find what? R. So we rearranged and we are finding this R by using this formula. Clear with this? So the cost of retained earnings is equal to dividend D1. Guys, again we have to use what? D1, not D0. So D1 divided by market price of the bond plus growth. So we'll do with this example. Fed Corporation have 90,000 shares of common stock outstanding with a par value of 1. What is this? Par value. Is this par value is a P0? Is the par value is a P0? Guys, is par value is a P0? Don't see the formula until no. Why par value is a P0? What is P0? That is what we, if the par value is P0, then all the 7 whatever we did, it is not required to do, because the question only they will given par value is this. So P0 is what? Current market price of the bond. So this par value, you ignore it. Okay. The market value of the bond is 21. So this is what? P0. So you take P0 as 21. The dividend on the common stock was 0.75 last year and is expected to grow by 4%. So I'll put 4% here. So 0.75 is for last year. And what will be for the next year? What will be the dividend for the next year? It is going by 4%. What is the dividend for the next year? 0.78. How I did this? D1 is equal to D0 into 1 plus G. So what is my D0? 0.75. 1 plus G is 1.04. You will get your D1. So how much it is? 0.78. So 0.78 divided by 21 plus 0.04, you will get 7.71%. So this is called as what? Cost of retained earnings. Clear? Any doubts in this? Par value is $2 and market price is $20 and dividend is growing by 5% and the last year dividend is $4. What is my cost of retained earnings? Try this. Try for the second, this also. So the book value is $1, market price is $40. The next year dividend is $2, growth rate is 7%. Yes, this is done. What will be the first one? How much? Yes, what is the cost of retained earnings for the first one? You didn't get it? How much is for the first one? No, 0.21. So market price is 20, growth is 5%. And what is the numerator you took? 4.2. So 4.2 divided by 20 plus growth is how much? 0.05. Everyone got the same? The cost of retained earnings 0.26. So 4.2 divided by 20 plus 0.05. So how much percentage it is? 26 percentage. And what is for the second one? So what is the numerator you took? 2. Why we are not multiplying with the dividend again? Because it's already next year. So 2 by 40, 0.07. How much it is? 12 percentage. Okay, 12 percentage. Yes, that's it. Clear with this? And next method is CAPM. If you do the CAPM, the R whatever you get, that R is your cost of retained earnings. This is for the existing one. The retained earnings is the existing one. Suppose if you are issuing the new share, instead of P0, right, you take PN. Instead of P0, we'll take what? PN. So what is the PN again? Issue price minus flotation cost. Whenever I issue new shares, what are the price minus flotation cost? That's it, simple as that. Clear with the cost of new common equity and the cost of retained earnings? Same, the dividend growth model only. If it is for the retained earnings, D1 divided by P0, current market price plus G. If I am issuing new share, instead of P0, I'll take what? PN. PN is the issuing price, whatever the price I have issued, the stock price I have issued minus flotation cost. Don't worry about the par value here. Okay. Next, at last, the cost of capital and capital structure and WACC. So the steps in calculating the cost is, so first, see, these are the steps. Once you understand the step, sorted, put it in the practical, done. Calculate the cost of individual component of capital structure. So in the capital structure means what and all is there? Equity, debt. Again, equity we can divide into common equity and preferred equity. Three things: equity, debt, and preferred equity. Common equity, preferred equity, and debt. Assess the firm's capital structure, understand their weight, and then calculate the WACC. Okay. So we'll understand this with an example. So in the capital structure, what and all we'll be having? Example, this is source of fund. So first we'll do a easier one, then we'll sit and calculate the complicated one, then we'll calculate everything. So the source of fund is coming from the debt, it's coming from the preferred stock and equity share, a new equity share, and the retained earnings. Now we calculate the cost, right? Cost of debt yesterday, cost of equity, cost of preferred share, cost of retained earnings. Example, take the cost of debt as 6%, this is 7%, this is 8, and this is 7.9. Take as this. This is cost. And the market value, we understood how to calculate the market value also. The market value of the debt, market value of the bond, equity share and preferred share, we did it. Okay. So take is this market value is 40,000, 60,000, and this is 20, and this is 80. First, what we'll do, we'll separately, if the question is given with the cost, take it. If the question is not given, you have to find. How to find? We did it. How to find the market value? We did it. So now we have to write in this format, and at last we have to sum it up all the amount. So what will be the amount? No, 200. Correct. Done. Now we have to wait. We have to write something called as weight, because right now we are going to calculate weighted average cost of capital. We are going to calculate what? Cost of capital. The weight we have to understand. How to calculate the weight? 2 lakh is a total amount. And how much weight the debt is having? 2 lakh is my asset. Now equity plus liability is the asset. So this is my asset. How much did debt bought? How much did the debt bought? So how much could be is bringing 20%, right? So it is 0.2. I mean, I'm making it in the decimal. And what about this preferred share is bringing 0.3. How to find this? 40 divided by 200,000. 60 divided by 200,000. Why 200,000? Total is 200. And 20 divided by 200,000. 0.1. 80 divided by 200,000. This will be the highest. 0.4. Now we got the weight also. Now what we have to do? Multiply with amount, multiply with weight, or cost multiply with weight. Think. What is WAC?
Weight multiply with
Weight multiply with amount.
cost.
But what we are calculating now? WAC is what? Cost. Weight is there. Cost is there. That makes the WAC. So you have to multiply the cost into weight. Now multiply 0.06 into 0.2. Or if you want to take it as a full percentage, take it. But the understanding is required at last. So 6 into 0.2 plus 7 into 0.3 plus 8 into 0.1 plus 7.9 into 0.4. At last, what is the total amount? Point. This is called as weighted average cost of capital. So the company at least should make how much? 7.26% from its investments. Then only they will be able to pay everyone. Okay. See the 7.26 in between all this. It is between 6, 7, 8. In between this, how much we have to make? 7.26. If we make 7.26, we can happily pay 6% for the debt, 7% for the preferred stock, 8% for equity, and retained earnings 7.9%. Easy as that. If it is given like this, it is easy. Just cost multiply by weight. But in the question, will be not given like that. You have to find the cost individually. You have to find the weight by yourself. Okay. So what I want to tell is ignore the book value. They'll give the book value. They will give the market value also. Don't take the book value only. Use book value. Take the par amount just to calculate the interest and dividend. Enough. The job is done. Okay. And sometimes they will not ask all the thing like find the cost of debt, find the cost of equity. So that question might be very big. One MCQ question. Find cost of debt. Find their market value. Cost of preferred share, find their market value. In that some portion they will give very easily. They will be written, this is the cost of retained earnings, or this is the cost of preferred stock, and this is the market value of the preferred stock. One might be given, one might be not given. So in that case, you understand and do it. So if it is this amount, here in this question I have given everything, but sometimes they might not give the cost. You have to find the cost. Clear with this? Now you know how to find the cost of debt. So what is the formula of cost of debt? Cost into 1 minus tax rate. You will get CD. Cost of debt you will get. And cost of preferred equity. What is cost of preferred equity? So don't mug up the formula. Understand the logic. What will be paying for the preferred stockholders? Dividend. So dividend divided by market value of the preferred stock. Again you will get the cost of preferred stock. Next, cost of equity will break into 2. Cost of retained earnings. Again, cost of preferred stock also is 2. If I am issuing newly and if the existing one. For the existing one, you told it's a market value. If it is new, the denominator is what? PN, which is net proceed. Issuing minus flotation cost. Again, we'll come to the equity. Equity, 2 models are there. Dividend, if they are paying a dividend, dividend growth model. If they are not paying the dividend, CAPM model. CAPM you already know. By using that R, that is the cost. And if it is dividend growth model, what is the formula? D1 divided by market price plus G. You will get what? You will get CRE, which means cost of retained earnings. And if I am issuing newly, the P0 is there, right? That I will change for PN. That's it. So you'll get the cost. And now when it comes to market value, for the bond, yesterday we did how to find the market value. How to find present value of all the future cash flow. I mean, the interest and the amount which will be received at the maturity, convert into present value. And for the equity and preferred stock, we did with 7 different model we did, right? By that you can get what the market value of the preferred stock and common stock. See, we are finding for one share, multiply with number of share, you will get the total amount. Simple as that. Okay, any doubts on the WAC? Yes, any doubts? If you want, you can start do the question of WAC at least today. You will understand more in it. There are multiple questions on the hawk only. You can try to do that. Okay. So again, this is a marginal cost of capital. See, suppose if the company want to open a new factory or want to raise a new money today, then this marginal cost of capital will come. Marginal cost means what? The one which we learned in the section C, right? Again, the same. The extra cost I'll incur if I issue extra money. If I'm going and issuing extra money from the shareholders or from the bondholders or something, what is the extra cost I will incur is known as marginal cost of capital. Okay. See, first they will use the cheapest money first, retained earnings, because they no need to go and borrow with someone. Once the money is drained out, they are forced to go and issue the new share, but there will be a flotation cost on this. Fine, we'll take a break and we'll start with the derivatives. Okay, so, but still here, any doubts on this WAC or cost of equity? Start with the long-term financial management. The last topic is introduction to derivatives. I mean, like the last topic is derivatives. So derivatives, I think there. Okay, so derivative is a financial instrument. So the value of the derivatives, it derives from some underlying asset. Example, now this is the derivative. Now the value of this derivative is derived from the underlying asset. So based on this movement of asset, the derivative value increase or decrease. This is how the derivatives work. So derivatives are related to asset. So how the asset, your underlying asset works, based on that your derivative will work. Okay. So three things we have to understand in the derivative. One is the underlying in the sense this is an actual variable you're betting to, like the asset depends upon this underlying part, and notional amount is nothing but the size, how much it is, like 1000, 100, 500, like this. And last is the settlement amount, the actual cash that changes at the end of the contract. So now we are going to discuss the four types of derivatives. So there are like these four types of derivatives are, one is forward contract, one is future contract, one is swap, and the last one is options. So in the forward contract, the agreement is they will set a price to carry out in future. Suppose example, if a person want to buy something in future, what could be the case for the buyer? If price increase would be a threat for the buyer, because if the price increasing for the raw materials, which will reduce his profit, so that is a problem. And for the seller, what is a threat? What would be the threat for the seller? A price decrease. Suppose I produce something, I want to sell it for the certain price. If the price decrease, suppose in the market, what if the price is going down, I'll be not able to sell for that particular price and make some profit. So what the buyer and seller will do, they will come to a contract and get into agreement and tell, see, I can buy for this price, and the seller will tell, okay, I can sell for this price. Okay, so that is called as forward contract. Clear with this, guys? Example, here you see a potato farmer want to sell the potato to the chip factory. So the potato farmer is worried about what? He's worried about the price increase, and the chips factory is worried about the potato farmer is worried about the price decrease, and the chips factory is worried about the price increase. And see, now the current price of bushel of potato is $20. However, the farmer is concerned with the price of potato decrease in the next 6 months. So now this guy want to sell the raw materials or the potato after 6 months. Now we don't know what could be the price. Either the price will because the vegetable price, right, even fluctuates. We don't know what it is. Because of this, they will get into the contract and tell me, see, I can sell at this price, and the chip factory will tell, okay, I can buy at this price. So if the market price is whatever it is, either might be 24, 25, and whatever it is, now they are set at the price of 20. They set the price per bushel is how much? $20. Now the price is $100. How much the potato farmer wants to sell? Like he has to sell at $20 only, and the chip factory will buy for $20 only. And what about if it is like $10? The chip factory is forced to buy the same potato for $20. So that is that price, they will come at the exactly on that particular date. They will sit, they have already set at this price, they will come and they will settle this transaction. Clear with this forward contract? So forward contract is an over the counter agreement between two parties to buy or sell an asset at a certain time in the future at a certain price. Certain time in the future at a certain price is known as forward contract. Okay, so here there are two parties. One is long party and short party. A long party is a person who is going to purchase the asset. Here, who is the chip factory is going to purchase the raw material, and the short party is a person who is ready to sell the asset. That's it. Now there is some value for this contract. See, they both got into contract, and this contract has the value. The value of the contract is the difference between the market price. The value of the contract is the difference between the market price and the present value of the forward delivery price. There is some forward delivery price is given, right? $20 is setted. Predetermined price is 20. The value of the contract is the price of that particular asset and the current present value of the forward delivery price. The difference is known as the value of the forward contract. Okay, so understood what is a forward contract? Forward contract means both buyer and seller come and they will get agree. One person is ready to sell and one person is ready to buy at a predetermined price at a particular date. Okay, now in the future contract is also same, but here the buyer and seller come at the future date and do it for the specified price. But here the trade is happening on the exchange and it is standardized. In the forward contract, the major problem was default risk. What if one person is not showing up? What if the market price of the potato is like $40 and this farmer is not showing up? Because in the market, if he's going and selling, he'll get for how much? He'll get 40. But as per the contract, how much he will get? Only 20. So what if he's not turning up? So there is a default risk. But in the future contract, no. In the future contract, there is a particular standardized exchanges there like a SEBI. So we can trade a futures here. So usually buyer and seller future contract simply close their position. Here, if you want also, you can also take the position.
Local one. This is an authorized.
Local one. Yeah, that is over the counter. We can tell over the counter, and this is the standardized and exchanges, not local. It termed as over the counter. Okay.
Like for the sake of understanding.
For the sake of understanding, you keep it local, but in CMA exam, don't make it as local. Make it as over the counter. Okay. But in the future contract, it is the exchange or standardized format. But the major difference is what, in the future in the forward contract, they will come, they will deliver their assets. But in the future contract, no, it is not required. They will just offset their position by one person will make a loss, one person will make a profit. Just they will transfer that profit enough. That's it. Suppose if you want also, you can take the bet on petrol, crude oil, copper, steel, iron. You can also purchase it from the exchanges. So you can get into contract, you can go, you can trade it, you can buy the forward contract, future contract, but you're not going to buy it. What is the use? Like you can buy like copper or crude oil also you can buy, but here the delivery will not happen. You buy, someone would have sold, so that is a seller and you are the buyer. What happened now? So that contract you buy, the contract someone sold. At some date this contract will get expired because there is some specified date, future date at a specified price. On that date someone will make a profit, someone will make a loss, obviously. So suppose you made a profit, they will transfer the money to you. Suppose they made a loss, like if they made a profit, you have to transfer the money of yours. That's it. Here the physical asset will not get exchanged. Here just they will offset the position. So this is a difference between forward and future. Forward contract is done with the dealers, future contract is with exchanges. Here there is no secondary market. Here again, suppose you bought the future contract, then you don't want to keep it till the expiry date, you can sell it to someone. Okay, contract terms are negotiated. Here it is standardized. Now closure of the delivery. See here, in the forward contract the asset is delivered, but in the future contract is just offset by the delivery date. Just they will offset the position by transferring the profit and loss. Here there is no collateral, but here they will have to pay some initial margin. Whoever is buying, right, they have to pay some initial margin. Credit risk, yeah, depend upon the credit worthiness, but none, because the exchange is there. Market participant is large companies, wide variety of companies, and even small players will be there in the future contract. Clear with this? So these are the two types of future contract. One is commodity future, one is financial future. Commodity future means the actual, like as I told, crude oil, petrol, iron, agricultural items, all this is traded. Financial future means like a debt securities and all. If I have a debt security at the specified price, it will, I want to sell or something is there, right? So I can get into the future contract and hedge the risk of the debt security. If you are holding a debt or a bond, what is the threat is there? Interest rate risk is there. If the interest rate increase, what happened to the bond value? Existing bond value will decrease or increase? Increase.
Decrease.
Why? Existing bond value will going down because in the market there are other bonds which is providing more interest than ours. Okay. Now, long and short position in the forward and future contract. The long position means who? The buyer, and the short position who is the seller. Example, the chip factory is in the long position. They lock the purchase price at 20. If the market price explode to 50, they make a profit. Why? Because the chip factory, if they go to market and buy the potato, they have to pay how much? $50. But they already in a contract with this farmer, so they can get for 20. Okay. Now for the seller, as a short position, the person who agrees to sell the asset in the future is known as whom? A short party, like a short position, we can tell. The market price, if going down, no problem, he can still sell it for $20. Suppose the market price of the potato is $5 today. So they are into the contract already. Now whatever the price in the market, don't worry. So the farmer can sell this potato to the chip factory for how much? $20. So the chip factory is forced to buy the potato for how much? $20. So who make a profit here? A farmer will make a profit here. Why? Because if he's going to market and sell it, he will get only 5. But as per the contract, he will get 20. Clear with this? Clear with the forward and future? And next we have interest rate and foreign currency swap. So interest rate swap is nothing but there are two companies. One company is paying a fixed interest and one company is paying a floating interest. One company is paying a fixed interest. Fixed interest means no matter whatever the interest rate in the market, there is some fixed interest rate is set, right? That interest he will be paying. Floating interest rate means in this contract, in this bond, the interest rate is depend upon the market. Suppose if the market interest rate is increasing, the bond interest rate will increase. The market interest rate decreasing, the bond interest rate will decrease. Now, a person who is having a real estate company, he is having like 10 houses, he is renting out. So his income is fixed or his income is floating. A person who is renting out places, fixed income. But this guy unfortunately got a loan which is having a floating interest. So that expense is not matching with the revenue because his revenue is fixed, but the expense is floating because whatever he earn in a fixed. What if the interest rate is increasing? There is a threat for him. He have to pay more interest. So what he will do? He'll find someone who want floating. Some other person income is depend upon the market interest rate. Some other person income is depend upon the market. So he is ready to buy the floating one and the real estate guy is ready to buy the fixed one. Now he no need to worry about the market because his income is fixed. He is happy paying this interest. So now this in the interest rate swap, what they will do? They will just swap their interest. You pay my interest, I'll pay your interest. But the principal amount will be same. He will not pay. You took 10 million, he took 1 million. So he will not pay for your 10 million. I mean, you should be also 1 million, he should be also 1 million. Principal amount is not exchanged. Just what is exchanged? Only the interest portion is exchanged. So now the fixed guy will get the floating guy will get the fixed. That's it.
The person who is swapping the floating interest charge, if he's getting loss, then
What if market interest rate is increasing?
so
He will make a profit. I was paying 8. I've had a floating. Okay. There was a fixed interest which is also 8. I exchange. Tomorrow the interest rate increased to 12. Because of the exchange, he make a profit. Still he have to pay how much now? Only 8. But whoever took a floating, he will be paying 12. There is a risk. Everything one obviously in the investment and in the trade or in the business, one has to make a profit, one has to lose it. That is how the investment works, right? So you buy a share. It is not that everyone will make a profit. If he is making a loss, then only will make a profit. Okay. Okay. Next is a foreign currency swap. In the foreign currency swap, here not only the interest rate is swapped. Here both interest and principal is swapped. Example. You are a US company. You took a loan in euros. And there is a European company who took a loan in US dollars. Okay. Now both is having what risk? Exchange rate risk. Exchange rate risk is there. What does the exchange rate risk mean? Suppose if my currency depreciate, I have to pay more. Example, now your IMA membership made more costlier because of Indian rupees falling. That is the risk you are having. Same way, the company who took a European loan for the US dollar, what is the risk of him? If your dollars is depreciating, he has to pay more US dollars. And for the European company, what is the threat? If European euro is depreciating, he has to pay more euros, like opposite way. Now both the companies telling, see, you are earning in euros, you pay my loan in the Europe. German company, I approached the German company, see, you took a loan in dollars, right? I will pay your loan here, you pay my loan here. Here not only interest rate they are swapping, interest and principal both swap by both the companies, known as foreign currency swap. Clear with this? Okay. Next, at last we have options. So 4 derivatives. What is derivative means? The value of the derivative is underlined by the asset's value. If asset increase or decrease, the derivative value is increase or decrease. Suppose in the forward and future contract, the difference between is what? Current market price and the exercise price, the specified price. So what if the current market price increase or decrease? The value of the derivative will also increase and decrease. In the option, in the forward, what? Both have to come, both have to exercise. There is no options. Opposite of this. Buyer has to come and buy. Seller has to come and sell. In the future also, you have to offset their position. But in the option, the buyer of the option, I'm not telling call option or put option. What I'm telling, the buyer of the option will have a right, will have a power to buy or sell something. Not only to buy or sell something. Who has a power? Buyer has a power. And the seller has to obey it. The seller don't have an option. And the buyer is also having an option not to sell or not to buy. What is a buyer is having? A buyer having a right to buy or sell the asset, but not obligation. But he don't have any responsibility to do it. I might buy or I might sell. But the seller don't have an option. Seller just what have to do? Seller just have to go like obey the orders of the buyer. Now, do you think the seller will do it for freely? Do anyone will listen freely? No, right? So seller will tell, see, okay, I'm ready to obey your orders, but you have to pay me some amount. That is called as option premium. That is a separate amount you have to pay. Either you buy, either you don't buy, either you sell, either you don't sell. If you want to get into contract, you have to approach the seller. See, take the premium, give me the right. Now the buyer having a right to what? Buy and sell. Now we'll come to the buying concept. When you will buy from the seller? When you will buy from the seller? See, I have a market price and I have some specified price. In the option, we are getting into some terms called as one set price is there. When you will buy from this guy? Logically, you think when you will buy? Compared to market, if my exercise price is less, I will buy. What if in the market is less? What you can do? You just go and buy in the market. So then you no need to buy from him. That is what the call option does. Now we'll come to put option. Put option means a right to sell. When you will sell to some person, like, I mean, in the market is there, and this option seller is there. When you will sell to him? When you will sell, see, me and Pawan got into contract and there is a market. When I can sell to Pawan, when I can sell to market? Compared to what? If it is low, I'll lose money, right? If it is high, compared to market, my exercise price is high, I will sell. So opposite, you term this in opposite way. If a market price is low, I will exercise the option. If market price is high, I will not exercise the option. Simple. In the buying concept, if a market price is high, I will not exercise. Sorry, I will exercise. Why? Because in the market, if I go and buy, it is higher. And if the market price is low, I will not exercise because I can go and buy from the market. Clear with this?
You are telling seller have right.
Seller don't have the right. Buyer have the right. I told right clearly. Who has the right? Buyer has the right. Seller just have obligation, just have to obey the orders. So who have the right? Seller have the right, but not obligation.
While selling, if the market is favorable, you can go for market rates.
Market is favorable, yes, go for market, but it's both perspective. Do you have the asset or you want the asset? When you want, means what you will do? You will buy or you will sell? You will buy. When you will buy from the market? When the market price is down. And when you will sell to the market? When the market price is high. Both are different. So as a buyer is a different, as a seller is a different. Buyer want cheap, a seller want high. Correct? So don't get confused with option buyer and seller. Don't get confused with asset buying and selling. Option buyer can sell the asset, can also buy the asset. If it is a call option, I have a power to buy. If it is a put option, I have a power to sell. Seller, if it is a call seller, he has to sell. If it is a put seller, he has to buy. Opposite. Clear?
Asset buyer and seller is different.
Option buyer and seller is different. If I want to buy, I will buy what? Call option. If I want to sell, I'll buy what? Put option. I'm buying. Both the times I'm buying only. But what I'm buying is different. If I want to buy something, what I'll buy? I'll buy call option. If I want to sell something, I'll buy put option. Both the times, see, I'm using the word called buy only. But what I'm buying, it matters. Okay. Now you understood the concept of the option. Who has a power? Buyer has a power. Seller just have the obligation. But the seller will not obey like as it is. So seller will charge something that is called as premium, an option premium. That amount you have to pay to the seller. See, I'm having some power against you, so take for that. So you have to pay something. So he will, okay, so he will tell, okay, I'm ready to sell for you, or I'm ready to buy from you. Okay, so whenever you're thinking from the buyer perspective, think opposite of the seller perspective. If buyer is making a profit, who is making a loss? Seller is making a loss. If buyer is making a loss, means seller is making a profit. Now one example, we'll take as a call option. Okay, in the market it is $24. Market price of the stock is 24, and with the seller, like seller of the option, is also 24. Now if I go to market, I'll get for 24, and if I exercise this option means going and buying from the seller. If I'm exercising the option also, I'll get for 24. Any profit or loss happened? Did anyone make a profit? Did anyone make a loss?
Seller made profit.
Seller made profit. Why?
He's getting sell.
Buyer made loss because he have paid premium.
Premium. See, either I go and exercise, either I am not going and exercising. Both are same. Suppose if I go to Pawan and tell, see, I am ready to buy the stock for $24. Market is also 24. If I'm going and asking Pawan, give me the stock, what he'll do? He'll buy from the market for 24 and sell me for 24. Any profit he made? No, not in this. But as he's an option seller, he received what? An option premium. That he will put in his pocket. That extra.
That for 26.
Yeah, whatever the premium we paid, example, we paid a premium of $2 means the $2 is a loss. Who made? An option buyer made. Option seller made $2 profit. So keep in mind every time this option premium. Whenever you make a profit, minus as a buyer, minus that option premium. Whenever seller make a loss, minus that option premium. Example, if Pawan made a loss of $5. Assume that it is in the market, it is for $17 or something. He made a loss of how much? $5. But net loss he will make only $3. Why? He would have received $2 in premium. And same way I would have, if he's made a $3 loss, means I made a not $5 profit. I also made a $3 profit. So opposite of it, a buyer will make an opposite of seller. So there are two types of option. One is call option and put option. So the option to buy the asset at the strike price. What is a call option is giving the power? A call option is giving you the power to buy the underlying asset at the strike price. What the put option is giving? Put option is giving the power to sell the asset at the strike price. In call option, the buyer of the option will buy the asset. The seller of the option will sell the asset. It's easy to term, but in the put option it is a little bit confusing. Why? Because the buyer of the option will sell the asset and seller of the option have to buy the asset. Suppose if I am getting into put option, what is the buyer is getting the power? The buyer is getting the power to sell the asset. If I sell, the other person has to buy. Okay, clear with this? So put option, it is like a tongue twister, say in opposite way. A buyer of the put option will get a power to sell, and seller of the put option will get a, seller of the put option has to buy the asset. Okay. There are two parties involved, and the other name of the seller is writer of the option. Okay, so the person who sold the option, again short position, long position, the name is again same. So, the seller of the option is a short position and the buyer of the option is in a long position. Okay, and here there will be some expiry date. This is the latest date at which the buyer might exercise the option. Again, the greater the time period between the point of sale, the exercise date, the greater the value of the option. Now there is some value of the option is there. Now the time period is more. The time period is more. So the risk is high or less? When the time is more, the risk is high. And when the risk is high, the return should also be high. Now the exercise price, this is a price the investor has to buy or sell the asset. This is also called as strike price. Okay. So the option price or premium, this is the amount that paid by the investor. Investor means buyer. To whom? To the writer. Writer means seller. So the investor has the option. The writer will keep this no matter what happens. No matter what happens, the money belongs to seller. Okay. The call option is to buy to asset. The put option is to sell. These options can be created just above any asset you take. You can do it. You can take financial asset. You can take non-financial asset. You can keep with anyone. Okay. Now we'll learn something in the money, out of the money, and at the money. Okay. Three terms. What and all? In the money, out of the money, and at the money. So this is for the call option, and the same term is repeated in the put option also. Okay, we'll understand this. Okay, call option, who has a power? Buyer has a power to what? To buy. So gives the buyer an option to buy but not the obligation, and the excess pay before the expiry date. Now I'll take three numbers and we'll understand this. Market price is $30. Market price is $28, and market price is $32. Guys, this is a call option. Okay. Now three different market price I have given. What it is? Three different market prices there. Now we can take a strike price is $28. What is the strike price?
28.
What does it now? You will convert into the statement. So a buyer of an option has a right to buy the asset for how much? $28, but not the obligation. Correct. So this is a strike price. Now we'll see the three different scenario. What if the market price is 30? What if the market price is 25? What if the market price is 32. First we'll see for 28. Easy as that. Now market price is how much? 28. Strike price is how much? 28. So if the market price is at the strike price, it is at the money. What is at the money? The market price and the strike price is equal. It is at the money. So this is at the money. Okay. Now either you buy the option, either you don't buy the option. There is no any value for this. So the value of the option is 0 now. Why the value of the option is 0? It's indifferent. Either you buy from here, either you buy from there. You are not making any money. So it is 0. Now we'll come to the other part. $30 will take. In the market, if you go and buy, you are getting for 30. But if you go with this guy, you can get this for 28. 1 minute. I'll change this to 26. Okay. In the market, if I go and purchase, I'll get for how much? 26. But if I use this option, I will get for 28. Now my simple question is, will you exercise this or you will not exercise this? Yes, no. If you go to market, you will get for 26. But if you exercise this option, example, if I go to the seller and I tell, see, sell the asset for how much? He will tell, I will sell for 28, because that is the contract between us. So now tell me, will you go to this option seller or you will go to market to buy this? You will go to market. Why? Because in the market, it is for 26. So you will not exercise. Now when you are not exercising the option, does the option is having any value? No, option doesn't. If something is valuable is what? You are gaining something, then only it is valuable. Logic. So here you are not gaining something. Here also your value of the option is 0. So here, if the market price here is what? If the market price is above the, below the strike price, right? Now here, yes, if the market price is below the strike price, it is out of the money. Here it is what? When you are not exercising, it is called as out of the money. Here, the market price is below the strike price, so it is out of the money. Now next one, 32. If you go to market, you will get this asset for $32. But if you exercise, you will get for how much? $28. Now tell me, will you exercise this or not? You will exercise, obviously, because this guy, if I go and ask, he will give for 28. But if I go to market, I have to purchase for 32. So you will exercise. So here you earn something. How much is the value you will have? $4. This is intrinsic value, will tell. The intrinsic value is how much? $4. So this is called in the money. Whenever the option is in the money, there is a value of the option. Clear with this? Understood this example? So the option is in the money. If the market price is above the strike price, the call option is in the money. Now don't mug up this. The direct opposite of this work in the put option. Because in the put option, it's opposite. Clear with this example? Okay. Now we'll come to the put option. Put option means what? An option to sell. Clear? Again, we'll take the 3 example. We'll understand this. Market price is 40, 42, 38, 42, 46. Okay. Now the strike price is 42. Strike price is 42. Okay. Now here the option buyer, what is the option buyer is having? An option to put option, right? An option to sell. The market price is 42. Strike price is also 42, which is equal. Market price and strike price is 42. Now here there is any value for the option? No. So again, this is called as at the money. See, if the market price and the strike price is same, the option is at the money. The market price is at the strike price. The put option is at the money. Same, copy paste for both. For call option and put option, at the money is easy. Next we'll come to 38. If you go and sell in the market, you will get how much? 38. But if you exercise this option, you will get how much? 42. What you will do? You will
Exercise.
exercise. Why you will exercise? Because he's giving more than. If you go to market, you will be able to sell for how much? 38. But this guy will give me how much? 42. So here you will exercise. So here you have some value. So what is the value that? How much is the value? $4 you make. The value of the option is $4. Now, if the market price is in the money, if the market price is below the strike price, so it is in the money. Opposite of call option. There the market price is in the below the strike price is it's out of the money. Here it is in the money. Why? Here the buyer perspective. Buyer will make the money. So here it is in the money. Now, will you exercise this? If you go and sell in the market, you will get for 46. But if you exercise, you will get 42. Will you sell to him or you will go and sell to the market? You will go and sell in the market. So will you exercise this option? No. So here also it is 0. So it is out of. It is in the money. In the money only they will make a profit. Okay. Clear with this? Any doubts on this? Easy as that. So 3 terms, put option is opposite of call option. Understand that enough. So whenever you take a question, understand whether it is a put option or call option. Think in the perspective of buyer. Think in the perspective of seller. What is the question want? If the question is asking, how much did the seller make? How much did a buyer make? In their perspective, you think it will be easier. In some question, they'll go more complicated and tell, suppose A Limited is buying a call option and selling the put, like selling the put option. Both are same or both are different? Buying a call option and selling a put option. Balaya garu. Example. See, A Limited is buying a call option. What does the buying a call option will give? Option to buy. Selling a put option, what does it give?
Obligation to buy.
Obligation to buy. So then both are in the buying case only. Either you buy a call option, either you sell a put option. Both are in the buying. Both here this guy is buying. So this is how the question will be. One side you will buy a call option, one side you will pay a you will sell the put option. Here you have to pay the option premium. Here he will get the option premium. Here also is buying. There also is buying. Okay. So in that case it will work out. Or it opposite. In the case of buying there is a flexibility, but in the case of selling there is no flexibility. You have to do it. Okay. In one question it is not necessary only one perspective they will ask. They will ask multiple. Buy a call option and buy a put option. Here one side is getting a power to buy, one side is getting a power to sell. But when it comes to sell call option, sell put option means no power, only obligation. But what you have to understand is here you will get some amount called as option premium. Okay, now we'll see what is the value of the option. We calculated the intrinsic value. How to calculate intrinsic value? When the option is in the money, you will get intrinsic value. Now the value of the option is having 2, intrinsic plus extrinsic value. Extrinsic value is nothing but a time value of money. Okay. So how to calculate this? Simple as that, nothing complicated. You know how to calculate intrinsic. Now extrinsic value is time value of money. So the time value of money means these 3 things is affected. 1, the time to left the expiry of the option. How many time is there? When the time is more riskier, more in extrinsic value. The time value of money and the market interest rate. The interest rate you used for the discounting rate, that will affect. And the volatility of underlying security. If it is high volatile means high riskier. When the high risky means the option value will increase. Why the option value will increase? High risky, so the option seller want what? See, this is a high riskier, I want more return. So it is more. So chances of bad happening is more. So the value of the total option premium is intrinsic plus extrinsic value. Example, you see here, an investor buy $60 call option. Who is buying here? An investor is buying a $60 call option at the contract for $3.5. Okay. And when the market price is 63. So the intrinsic value is what? So intrinsic value is $3. Why intrinsic value is $3? See, the exercise price is how much for the call option? 60. And if this guy go to market and buy this stock, how much it is? 63. So it is in the money, out of the money, or at the money? In the money. Why? Because he is making $3 more. So that is intrinsic value. And is paying the premium how much? 3.5. So this is extrinsic value. 3.5 minus 3 left out is what? Extrinsic value, which is time value. Okay. Now we'll use this call option and put option to make some profit or to hedge.
Deducting that premium, it is extrinsic.
A plus B is equal to C means A minus C is equal to B. Clear? So hedging strategies with put and call option. Now we use put option and call option to protect from something. Now you already, here you're not buying an option or something to buy something or sell something. Understand this. You already have a share. You already have shares. You already have. Now what is the problem holding the share? What is the threat or what is the risk of holding the share? Volatility, or like suppose you have a shares of Swiggy. You buy the share for 250 or 300. So what is the risk you have? Share price is increasing the risk or decreasing is the risk? Decreasing the risk. So if the price decrease and if you want to sell at some period, what you will make? You will make the loss. Now if you already have a share, will you buy the call option? Will you buy the put option? You will buy. Why you will buy the put option? Because you want to sell. If you are already having a Swiggy share, you want to sell. You are not planning to buy more shares of Swiggy. You just want to sell it. So when you want to sell it, you are worried about the price decrease. So you will buy what? You will buy put option. So when you are buying the put option, what it is? Okay, no need to worry. Whatever the market price, I'm with this contract with this guy, strike price, I'll sell at this. Simple as that. So example, an investor purchased 100 share of ABC at 91. For how much he purchased? 91. A protection against decline this, he buys a put option for $90. So the exercise price is how much? 90. So whatever the price of the stock, I have a power to sell for how much? 90. But this guy charged me how much? $2. Now what is the total cost of not 92, 93, 91? I buy the stock. With that I paid $2 and buy the option. So total cost is 93. So if I want to make a profit, I should make more than $3 or else it's a break even or a loss. Okay. Now I buy 100 shares. So I'll pay how much? $90 for the contract. So the put option increase the investor cost basis to 93. So we pay in total how much? 9,300. I mean, I paid 91 plus 2. I paid total 9,300. The purchase of the put minimum guarantees for how much? I can sell this for how much? $90. Okay. The investor potential loss is limited to $3. Now what is the maximum loss I can incur? 3, not more than that. Why 3? Because now the stock price is $50. For how much I can sell? 90. So if you have not bought this option, you buy it for 91 and you have to sell for 50. So how much you will make? $41 you will make loss. But now you have an option. So now you will sell for 90. But you paid how much for everything? 93. So you will make a loss of only $3. So here it is not to make a profit. The options are not made to make some huge profit. It is here to hedge your value, hedge your losses. To protect this, now if the stock price is $200, how much will make a profit? $107 will make a profit. 107 you will make a profit. But what is the loss? The loss is limited to only 3. See, by taking a put option is protecting against the loss. The profit is no problem. He can make whatever the profit is. If the stock prices keep on increasing, he'll make. So, but the loss is limited to 3. So by taking a put option, he protected his loss. So now what happened? However, because the stock outlay the position for 90 and the stock price is 2, 93 become the break even point. Suppose if I'm selling, if the market price is 93, if I sold also, I will reach to the break even. Only of the stock, only after 93, if I sell, I'll make some profit. Okay, we'll see this. Market price is different. Will I make profit anything here? Yes, I'll make $600. 99 minus 93 is how much? 96. So I'll make $600 of profit. In one share, I'll make 6. In 100 share, 100 into 6, 600. Now 96, 90, 93, you see, I'll make 0. But now the stock price, you see, 84, 87 and 90. What could be the loss in these three cases? The loss is limited to 300. Now, whatever the loss can go, my loss is limited to 300. Now if it is $100, even if it is $1 also, I can sell for how much? 90. So my loss is 300. So I limited my loss to $300. This is how we use put option to hedge. Okay. Now maximum loss is how much? 300. And the maximum gain is unlimited. Maximum gain unlimited means what if the stock price is going to $1,000? That is unlimited. But I made my loss limited. That is the point. I made my loss limited. This is when you have a call option. Sorry, put option you have to buy. Now we'll buy the call option. When you will buy the call option? When you want to buy. You don't have a share, you want to buy the share. But we learn a different concept called as going short. What is going short means? How a person will make a profit in the stock? Buy at low price, sell at high price. Anything. This is how you will make a profit. But this guy sold first and buy later. You can do this in the stock market. How it is? First sell, then buy later. But the underlying concept is same. You sell at high price and buy at low price. Now he sold it. I mean, he took a short position. Now he want what? He want to buy the stock. He sold earlier. Now he want to buy. Now what is the problem with the buying? What was the problem in the selling? What was the problem in the selling? The price is going down. What is the problem in the buying? Price is going up. So what he will make? He will take what option? Call option. Now whatever the price might go up, I will tell this is the price I am coming and buying from you. So I will limit my losses. But if it is whatever it is increasing, I don't worry. I'll go and buy for that particular price. So then I will have to buy what option? Call option. It is called as going short. Going short means what? First I will sell, then I will buy. First I will sell, then I will buy. So that is going short. So second thing what I am doing, what is my second action? My second action is buying. So the threat of buying is what? If it is a price of the stock is high, I'll make losses. Example, I sold something for $100. My buying should be more than 100 or lesser than 100? Lesser than 100, then only I'll make a profit. What if the stock price is going to 120? I will make loss because I am forced to buy for how much? 120. So ultimately that only will come. I bought for 120, I sold for 100. Only the time difference. Concept is buy less or sell more. But the threat is what? The price increase is a threat. So what I gonna do? I gonna take what option? Call option. So what is the call option gives? A call option gives a power or a right to buy something at a specified price, but not the obligation. So we'll see with an example. So we went a short at $48. We went the short at $48. Now the investor also buy a contract for November for 50, call it $3 per share. How much I am paying? $3 per share. What is it? Premium. I'm paying $3 as a premium. Okay. The premium on the option contract decrease the investor net proceed and the short sale to $45. What it is? Say I sold something for 48, but I took the premium for $3. Now the net selling price is for how much? 45. Think in opposite way of the buying. There it was 91 plus 2 you did. Here 48 you got by selling. You gave $3 to whom? And to buy a premium. So how much you got now? 45. You are in your hand. How much you are having? Only 45. Now you have to buy for how much? Lesser than 45. If the price is going above 45, it is a problem. So what you will do, you will get in that contract. So you will put the contract with $50. Now whatever price in the market, what I will do, I will come and buy from you for how much? $50. Now I'm limiting my loss. What is my loss? I am limiting to $500. Now if the stock price is 100, assume that if the stock price is 100, for how much I can go and buy from him? Like for now the stock price is $100. What is the strike price we are having with the option seller? 50. I told I will come and buy from you for 50. Now I bought for 50. I sold for how much? 48, but $3 went option. 40, net is 45. So how much I made a loss? 500. Now the stock price is 1000. Still I will go and buy for how much? 50 only. But what if I wouldn't have bought this? I make a almost $950 of losses. Now what you did? You limited your losses. So you limited a losses still. So maximum loss is how much? 500. And the maximum gain is 4500. Here you can't tell unlimited gain. Going, how much it can go? This share price can go till lesser than till $1. I purchased for $1, I sold for $45. So maximum I can make is 4500. In the short, there is limited. Okay. Clear with this? How to use call option and put option to hedge your losses. That's it. Okay. Done with your long-term financial management. So 2 topic is done: risk and return, long-term financial management. And the third topic, yeah, this is completely going to be a theoretical. Theoretical means understanding how the stock market works and everything. So this is called as rising capital and capital markets. Yeah, we'll take 5 minutes break and we'll start at 12:30. So we'll come back after 12. So
Sorry, you also cleared it. That too 450%.
So if you go to like a job or somewhere, if you don't have a certificate also, they will tell, okay, attest your result sheet, come back, we'll get it. Same way, I have my result sheet. Result sheet was more enough. To apply might be next. I don't know if required. Photo frame.
You will be keeping part. But still, you should have kept.
Yes, sir. Today, Navya helped him to get the photo frame. Okay, so two topic is done: risk and return and long-term financial management. Now we'll start. Like now, rest everything is going to be short topic. So raising capital and capital markets. So if a company want a new fund, first what they'll do? They'll go inside and take all the retained earnings. Then they will go to the bank. They'll do lease or go to the venture capitalist, or they will issue common stock or preferred stock, or they will issue the bonds. Now, first, using the retained earnings may be possible for the company. Suppose the external option also include either I can go to the bank and take loans, or I can do lease financing, or I can do venture capital. For this, for whom? For the privately held company. So there are private company and public company. Public company whose shares are traded actively in the market, public company, and private company whose shares are not traded actively in the stock market. So this private company have three options. Either they can go to the bank and take a loan if they want a fund, or they can do lease financing, or they can do venture capital funding. What is this venture capital funding? Means like VC funding. They will go to the investors and ask for money. They will invest in the company. Commercial bank loan means like company offer long-term commercial loan for long-term needs. Term loans are more than 1 year. They usually use to purchase fixed asset, but they can also use for other long-term asset. Okay. Next, in the lease financing means what? A lease is an alternative form of financing a business. Here, the lease is a contractual agreement between whom? Lessor and lessee that gives the lease. What does it give? A right to use the specific asset for the specific period of time. In return, some cash payment. Like a rent only you can consider. So advantage of leasing is what? Convenience for the short-term lease, 100% financing, protection against obsolescence, and flexibility. Suppose if I buy some asset, I want only for 2 years. But if I buy some asset, what I have to do? I have to use it, then I have to sell it to someone. There is no flexibility. But if I want to buy, if I want to use something for 2 years, what am I going to do? I'll go and I'll do the lease. Rather than taking a loan and buying an asset, I'll take a lease. That's it. So now we'll do lease versus purchase analysis. So compare the cost benefit analysis we'll do, right? Same as that. Make or buy decision we did. The same here also we'll do lease versus purchase. But here you have to consider what? Time value of money is considered. Okay. This company's lease payment is $24,000 per year for the next 5 years. And if I want to purchase the truck today, I have to pay how much? $100,000. Two options is there. I can lease this asset for $24,000 for the next 5 years. And the interest rate is 5%. The cement work can purchase the truck for $100,000 today. Now you have to compare which is better. So first what? 24,000 I'm paying when? In next 5 years. So I'm sitting and taking a decision today. So what I'll do? Either I have to pay today 1 lakh, or either I have to pay 24,000 next 5 years. So this next 5 years is that the cash flow is different. So what I have to do again here, convert that cash flow into present value. But here the cash flow is same, right? You can use what? Annuity factor. Try with an annuity factor and do this. What is the present value of this 24,000? $4.329 into 24,000. See how 1 divided by 1.05, 5 time price is equal to, click on GT, you will get 4.329, multiply with 24,000, you will get 1,03,896. Now, if I am doing a lease, okay, how much?
907.
8.
No, sir, 897.
Oh, you are taking a full decimal, right? That could be a reason. Here they have taken only 4.329. Okay, 1,03,800 or 900 you take. So if I'm leasing, what is the present value of all the future payment? 1,03,800. But if I pay today, how much I have to pay? If I'm purchasing 1 lakh. So what is better now? Paying 1 lakh is better. But don't compare like 24 into 5. Then compare. The point is, whatever you are paying in future, convert that into present value. That's it. In the section B, convert into present value. But in section C, don't do it. Because in the CVP analysis, we ignore time value of money. That is the assumption we have in the CVP analysis. Okay. Next, venture capital is the third option where you can go and buy, take some fund. So venture capitalist means what? It's like initially they'll fund. So it is little bit expensive form. Because you are a startup company, you don't have any much income, they are taking more risk. So when more risk, more of your share to be given to the venture capitalist. So in return of money, what you will give? You will give the percentage of ownership. That's it, like a equity only. 3 things. What are the 3 things a private company is having an option? Loan, lease, VC. Okay. Now we'll come to public company. See, public company is having an option what? They can issue the common share and preferred share. They can go and buy the debt, loan, bonds they can issue. Now we'll come to this common stock issue in the primary market. So types of equity issue. The first time a company sells share is called as IPO. Suppose my company was a private company. I had a small private company. I was running, I was making profit. Then I came to IPO. IPO means what? Initial public offering, where my company shares I'm issuing to the public. So I'll call all the public and tell, see, you can buy my shares at this certain price. That is called as initial public offering. And the subsequent offering is an offering of additional share to the public after the issuing as an initial public offering. So I issued one time. After 5 years, I am coming and issuing again. So that is called as subsequent offering. Last year, I think Adani shares have been subsequently they issued. Once again, they came to the stock markets, secondary offering they did. When newly issued shares are offered for sale, it is a primary offering. When newly issued shares are offered for sale, it is primary offering. And the secondary offering is a sale of existing security by one major stockholder who want to liquidate. What is the secondary offering means? You are already the owner. You are already owner. Now you want to sell this share to someone. Not the company is selling the shares. A shareholder is making some money. It's called as secondary offering. Clear? What is secondary offering? A shareholder is selling his shares and liquidating, making some money. Example, the VC initially invested, right? He got some shares. Then it will come to the public. Then what he will do? He will sell his shares for the higher price. That is how the VCs will make the profit. Okay. Now the primary market. When a newly issued securities are offered to the public by a company, they are issued in primary market. Now a company is coming to IPO. They will come to which market? They will come to the primary market and they will issue the IPO. That is usually issued through whom? Investment banks. See, a company will issue like 1 lakh, 2 lakh shares. Not everyone is ready to buy. No, some company will have a demand. Some company might not have a demand. Then what they will do? They will go to the investment bank and tell, see, I am issuing the shares. Please issue my share and give it. So we learned PN, right? PN is what? Issue price minus flotation cost. Then this investment bank will tell, give me some flotation cost. Okay. So the investment bank are intermediate that bring together whom? A person who is searching new capital with the investor in investment. What does the bank do? It connects. I want to invest. You want money. You want an investor and I want to invest. Who will connect? Investment bank will connect. So they will earn this some money. So these are the three major roles they play. It helps in customer to design with deal and security. It underwrites is by the new share. What is underwrite means? Suppose if I am issuing the share for 50, I will go to the investment bank. The investment bank will tell, see, I'll buy from you for 40 and I will issue to your customer for 50. So he is underwriting. So then he will make $10 profit on each share. Okay. So the issue price is how much? 50. But who is taking $10? Investment banks are taking $10. Then the market issue to the public. So the underwriting means if the investment bank underwrite the new issue of securities, it purchase some or all of new securities in order to resell. Why is purchasing? In order to resell. The new issue is usually not purchased entirely by the original investment bank in the deal, but rather syndicated. Sometimes one bank will not purchase. Many banks will come in a motto of selling your company share. Not one. So that is called a syndicate. Okay. Types of underwriting. In a firm commitment, the underwriter agrees to purchase the entire issue and absorb any securities. So there are two types of underwriting. One type, they will try their best effort to sell. But if I'm not able to sell, I will give it back to your share. But next one is a commitment they make. Either I'm selling, I'm not selling, don't worry. I'm taking full responsibility. So there he can't come back and give, see, take your share, I'm not able to sell. So one is what? A firm commitment, agree to purchase the entire share and absorb any security that are not able to resell. Suppose if the investment bank is not able to resell, who will take care of it? Investment bank will take care. Next type is what? Best effort. Here the investment bank will act as an agent rather than the principal and will simply market the new issue without underwriting it. Simply do the marketing. What is the profit for this investment bank or the underwriter is? In underwriting process, the part of negotiation is the price at which the underwriter will purchase the security. They will buy for $50 and they will sell for $60 to the public. So the extra $10 they made is a profit. So that is called as underwriting spread. It is called as what? Underwriting spread. Next, the company can issue what? Equity, or then now come and issue the debt. So a company can issue the bond as also source of financing. Here also the role of underwriter will be same as the issuance of share. Here the underwriter will come, he will issue the bonds for you. Okay, private placement means an issuer may also sell the bond for the private placement without the use of investment bank to avoid the underwriting fee. I can directly go to the investor and tell, see, I have some bond, please purchase bond. Private placements are more commonly used for bond than stocks. Next, financial market. We understand the primary market. What is the job of a primary market? Here, the issuing company will come and issue the shares freshly for the IPO. But secondary market is a place after the initial issue, the securities are traded in the secondary market. You buy it, you got an allotment in the IPO. You got Tata Technologies shares. Now you want to sell it to someone. So you will come to where? You will come to secondary market and you will sell it. Clear? You buy a shares initially from the primary market, then you trade this in the secondary market. So the primary purpose is for the liquidity. You buy the share to make some money. So for that liquidity will come to secondary market. Now we have something called as capital market and money market. What is the capital market means? It's for the long-term financing. Maturity period is more than 1 year. Example, equities, corporate bonds and everything. But money market is for short-term purpose. Short-term loans at all is required, right? So like a treasury bill, commercial paper. For this they will come to the money market. Understood what is capital market and money market? Capital market, the maturity period is more than 1 year. Money market maturity period is lesser than 1 year for short-term purpose. Next we have market efficiency. So there is something called as market hypothesis theorem. So which means market efficiency means the market price of the security take all information about the market, including public, economy specific security and market in which the security is traded. So market efficiency means the market price of the stock is already having all the information in it. Any new information will not affect this. I mean, there will be no any new information. So the price you see on the market is already affected by all the information is called as market efficiency. Any new information, the past information, the present information is already affected. Example, when there is some news, what happened to the market price? Example, if some company have received government contract to build something, to construct something, to provide something to the government. So what happened to the revenue? The revenue will increase. When the revenue is increased, what happened to the this news will go to the market and the stock price will also increase. So market, highly efficient market tells this news is already reflected in the market price. It is not that some news is going to come because of that, it's already affected. So the new information, as a result of the efficient market, the security prices are set to fluctuate randomly about their intrinsic value, because the adjustment to the price are constantly taking place in response to what? New information received. So these are the new three information. One is past patterns, pricing, trading volume, one information. All the published information, any information which is published. Third, there will be some information which outside world doesn't know. Only it knows by some management or something. They can make some profit if they have some insider information. This says if the market is highly efficient means the market price is already affected with this insider information. So there are three types of efficiency. One is weak, semi-strong and strong. Weak will have only historical information. Weak market will have only historical information. Semi-strong will have historical, not only historical price and trading volume, but also other published information. It has two information. What and all? Historical information and published information. Strong form of efficiency means that security price reflect all possible information, including the private information known only to insiders. Strong form of efficiency means it is affected by all the possible information. Clear? And there is something called as insider trading. So don't ever do this. It is illegal because it is a violation of fiduciary duty owed to the shareholders. What is this insider information? Suppose I told the government contract is there, right? Before it is knowing to the public, a manager knows this. What he will do? He will use this information and he will not trade on his account. If he trade on his account, red-handed he will get catch. No one will do it. Suppose if you have like this, don't ever try to do it. First of all, you are doing a fraud. Then upon that you will get a caught so easily. When there is some insider information, these guys are actively tracked by SEBI. Which one? The high level of management, right? Who know all this insider information of the company, which is already traded in the stock market. They are highly tracked. And some US companies or US banks, right? Suppose you work in some investment banks and all, you will be not able to trade in the stock market only. Why? Because these banks will know some information which the public doesn't know. There are few investment banks where employees they are working, right? Not the high level employee I'm telling. The lower level employees who are working in the operations as an associates also, they will be also not able to trade in stock market by using some stocks. Why? Because they will be not able to buy some mutual funds also, because mutual funds are made up of few stocks. This guy knows some insider information about this stock means he can make some extra profit. So to regulate this, what they'll do, they will stop. But if he is passing to someone else or doing some insider information, yeah, it's illegal to do it. By using the insider information, you can't make profit. Okay. So that's it with rising capital. Clear with this? So we cleared 3 topics. What and all is clear? Sorry? What and all? Risk and return. Long-term financial management. In long-term financial management, there are few subtopics. What and all is that? Yes, long-term financial instrument, cost of capital, derivatives. Okay. Next, we cleared what? Rising capital. The next topic is about working capital management. Not yet, right? Still not fresh. What is there in fresh? You assume the topics are fresh. Think every page is a fresh. Fine. We'll okay. We'll take lunch break and come back. We will start with working capital management. So where is this enough? So we did everything for the long-term fund. We did everything for long-term fund, right? But the company required liquidity to run. It is not that a company is having a lot of asset in machinery and land or building. It doesn't work. Company want what? Company want cash to run the business, to work every day. So we want working capital. So we did some, we learned something from the section A regarding the working capital. So working capital means what? Working capital is nothing but your current asset. Net, if they are asking, net working capital means what? Current asset minus current liability. Okay, so the components of working capital is what and all? Current asset and current liability. Example, see the current asset, marketable securities, account receivable, inventory, prepaids. Current liabilities, accounts payable, accrued expense, short-term finance or debt. Anything which have to pay within 1 year is a current liability. Okay, but the rule of cash management is what? We want to speed up the collection and slow down the payments. Why speed up the collection? Suppose if some customer want to give the money, is you have to try to get the money as soon as possible because the cash is required to run the business. And slow down the disbursement means we, as much as possible, we have to slow down the payment. First of all, reputation should be not should be at the stake. I mean, you can't keep on delaying like that only with the supplier. Next day he will be not giving the goods on time then, or he will tell, see, you are not paying the money on time, so we are not going to supply the goods. The suppliers will tell. So understand that, and we have to delay the payment as long as legally and ethically possible without damaging the relationship. You can delay the payment. So if the supplier told pay on 30th April, pay on 30th April only, don't pay earlier, because legally, ethically 30th April is fine. So we'll pay on 30th April. Okay. The cost of missing a discount. This is what we are going to learn in section in this particular topic. So let me put like this. Suppose if a supplier is telling, okay, you can take the discount, you have a time to make the payment till 30 days. You have time to make the payment till 30. But if you are making a payment within 10 days, what you will get? You will get 2% discount. This is how it is written. 2 by 10 net 30, which means if you make a payment within 10 days, you will get 2% discount, or you have to pay total on 30th. I mean, on 30th means on 30 days. In 30 days, you have to make the payment. What if the company is keeping the discount? I mean, if the company is keeping the discount, what is missing? If he is not paying on 10th, he is missing 2%, which means he has to pay 2% extra. So when I say he has to pay 2% extra, means it is like an interest. I'm not telling it's an interest. As a decision maker point of view, think it as an interest. How much interest you are paying? 2% interest. But that too, within how many days you are paying 2% interest? Within 20 days you are paying 2% interest. That you understood? You are paying 2% interest within 20 days. Now this is for 20 days. Now make it, annualize it. Then annually how much it will be? If within 20 days you are paying 2%. In 365 days, how much? You convert that into 365 days. Okay. Within 20 days, you are paying 2%, means, suppose if it is 40 days, 4%. Like that. Within a month, you are paying 2%. So approximately, if you want to tell, it will be nearly 24 or nearly 30%. Correct. Like, we'll see the formula, we'll see the calculation, but the underlying understanding is this. What is the underlying understanding? Suppose if I am not taking a discount, what is the cost? 20 divided by 365. No, if you do that, you will not get. So we'll annualize it. We'll see. We have a formula. We'll annualize. But my thing is like understand the baseline that if you're not taking a discount, you are taking as a interest. Not exactly, but you think. But that too, you are paying an interest within 20 days. Then we have to annualize that. That is called as what? Cost of not taking a discount. This is called as cost of not taking a discount. Why we calculate this is, now you have an option to take a loan from the bank. That guy is giving a certain percentage. Now, if that percentage is lesser than this, what you can do? You take the loan, pay earlier. But if it is opposite, don't take the loan. Let the discount go away. That is what we have to consider. Okay. Now, understood that example? The cost of giving up 2% discount translate into massive annualized effective interest rate. The 2% will be converted into heavy interest rate. So that is called as cost of not taking the discount. And we have other short-term financing. Either you take a bank loan, factoring receivable. We'll see the calculation, but right now understand what is factoring receivables means. You have your account receivable, right? You can sell the account receivable. With or without recourse, you can sell the account receivable to someone. Why we are doing this? Because account receivable told he will give after 90 days, but we want cash today. So then we go to some bank, tell, see, you collect from my account receivable. In BCom, you would have learned this discounting of bills. We'll give the invoice to the bank, tell the bank to go and collect with them. But now you discount and give me the rest amount. Suppose I gave account receivable 1 lakh. We'll see the calculation. Then I will tell, give me 95. You go and collect 1 lakh from him. So that 5,000 the bank will earn. For our agenda is what? To get the cash. So we'll get the cash. Third, we have a secured and unsecured financing. What is secured financing means? You are keeping some collateral like a inventory or some building or some asset. So if you are keeping collateral, yesterday we learned, right? Mortgage bond is less riskier. So we'll pay less interest. So it is cheaper. And which is unsecured means high interest rate. Why? Because the bank is taking more risk. So we have to pay more interest. Okay. Now we'll discuss this operating cycle and cash cycle, which we already done in part 1. So I showed with an example, we did what is operating cycle and cash cycle. So if you know the activity ratio in part 1, sorry, in section A, it is easy as that. Nothing is there on this. What is operating cycle means? It is a days you're taking to convert your inventory into sale and the sale into cash. Cash cycle means minus the time you're taking to make the payment. You'll get the cash cycle. Example, the company has an average age of inventory is 120 days. The company is taking how many days to sell the inventory? 120 days. An average age of account receivable is 100 days. We are taking 100 days to what? To collect, to make the payment. They are taking 100 days to make the payment. And they are taking 40 days to collect the cash. Now what is operating cycle? Sorry, operating cycle is told the number of days it takes to convert an inventory into sale and sale into cash. So how many days they took for the inventory? 120. See, 120 days. Next, how many days they took for collect that sale into cash? 40. So total what is operating cycle? 160. And how these days got? We have a formula. Days sales in receivable and days inventory. Okay. So by using that formula, we'll get in days. I mean, then you have to convert that turnover ratio into days. Okay. Now, when it comes to cash cycle means what? The number of days. We have one more details. The number of days you are taking time to make the payment. How many days you are taking? 100 days. So 160 days is what? Operating cycle. And how many days you took to make the payment? 100 days. So remaining 60 days is your cash cycle. So this 60 days, whose money is stuck? Your money. The company's money is stuck exactly not for 160 days. Suppose assume that paid on the day of the inventory only. I don't have any accounts payable days and all. First day. So how many days I'm taking to convert into inventory? 120 plus 40. I will taking that inventory into cash. So my money is stuck for 160 days if I'm making on the day one. But I'm using the leverage of the supplier. Supplier told, hey, you take 100 days time. So my 160 days of money which is getting stuck, 100 days, who is compensating? My supplier is compensating. See, you don't worry, I'll take 100 days of yours. So we are Jan 1st if I took. After 100 days, I'll pay him. Maybe in the month of April. April 10th, I will pay him. From Jan 1st to April 10th, my money is not used. It's supplier's money. But exactly when I am collecting the cash, after 160 days, so approximately 5 months, more than 5 months, in the month of June I'm collecting. So from April to June only I have to worry. Only this 60 days, May and June. I'll worry about that April remaining days and May and in June little bit days. So only 60 days I have to manage the cash. So why it is very important is, so this 60 days your cash is involved. So you have to find the source of this cash. Either you take a loan, either you get it with the investors, somehow. Only 60 days you enough. Clear with this? Okay. Now working capital is equal to what? Current asset minus current liability. Now there are types of working capital: permanent working capital and temporary working capital. So permanent working capital means this is a minimum working capital that is maintained all time. All time this much working capital will be there. Temporary means anything more than that is temporary working capital. Okay. Changing in working capital. My working capital will increase. My net working capital will increase when and all? When my current asset is increasing and my current liabilities are decreasing. And opposite. When my net working capital will decrease, when my current asset is decreasing, current liability is increasing. Okay. So these are the components of working capital. I'm not telling net working capital, components of working capital. Working capital is equal to current asset. Net working capital means asset minus liability. What and all is there? Cash, marketable securities, receivables, and inventory. So these 4 things are called as what? Current assets. Done? Sorted? Now first we'll go and see the cash management. So we have 4 things, right? So prepaid expenses also there, but there is nothing to manage that. Leave it up. Now these 4 things we'll manage. How to manage? First we'll manage the cash. Now, what and all reason a company will hold a cash? Because holding a cash is a good thing or a bad thing? Sometimes, some extent it is good. But can you hold a lot of cash? No. Why a lot of cash is not held? Because opportunity cost, time value of money, money value is decreasing, all this is there. So what and all reason you could hold a cash? So still you have to hold some cash, right? So what and all reason you will hold a cash? Why the liquidity is required? To pay suppliers. So what it is called as a day-to-day operation, we require a cash. A day-to-day operation. Only this much is enough. In your home, some cash is held. Some they will buy some asset, gold or land they will buy, or vehicle, building, something. But they will still hold the cash. In a house, will still hold some cash. What and all reason? For day-to-day grocery bills. Next, emergency purposes. Same, the business will also hold for emergency purposes. And next, what could be the reason? Speculative. Suppose if any opportunity comes in my way, I can invest it. Suppose if I don't have a cash, I'll miss that opportunity. So for that reason, for the potential investment, we'll hold it. Okay. So the reason for held to cash is one medium of exchange to make the payments. Next, precaution, that emergency fund. Speculation. If any opportunity come, I'll go and put my money. Last one is compensating balance. Compensating balance is in the bank account, there is minimum balance and all is there. If someone told you have to maintain this much balance, means that much balance will maintain. These are the reason we are holding the cash. Now, goal of the cash management is what? Accelerate the cash inflow slow down the cash outflow. Now there is something called as float. Float means it is a time gap between the date when you read a transaction, I mean when you write a transaction, and when it actually hit into the bank account. Suppose I'm paying through check. Today I paid you through check. What I'll do in my accounts today? I'll go and write accounts payable to cash. Accounts payable is reducing, cash is going out. But on the same date, is it getting debited from my bank account? No. It might get debited. First, my supplier has to go and drop the check in the bank. The bank again will take 1 or 2 days to settle the check. So might be take some days. So the time gap between the written right, the date till the amount is hitting or getting debited from a bank account or crediting to my bank account is called as float. Clear with this? It is a dead time between when the customer put a check in the mail and when you actually spend that cash in your bank account. Same way for a mail means post. Oh, in mail means post. We learned email, right? Email is electronic post, the one which we do email. But usually post box, we call it mailbox. What is another name of post box? Mailbox. Correct. So the check is dropped to mail. Suppose today's world, yeah, everything is on online. We'll make the RTGS or NEFT payment. But still, there are a few companies who are following the check system still. Why the check system is followed is because of the float only. It's an advantage. Supplier came asking money. Give the check. Sorted. You have gave the check on the date he asked. But he has to go. He has to take the check. Have to drop in a bank. The bank will process 2 or 3 days. Now, I can get 3 days or 4 days extra time. That 4 days, the cash will be in my bank account. The day the bank is processing, at that time, if I keep the bank in cash in the bank account is enough. So I can earn 4 days extra interest. This billions and $1,000,000, 4 days interest is equal to one team member salary. So that 4 days they can manage that, right? So that is what they will still drop a check. But RTGS and NEFT means today I transfer, today only they will get. So that is the reason they'll drop a check. So what is this? Slow down the cash outflow. These are the techniques they use to slow down the cash outflow. Now understand the float. Now float in the collection float or disbursement float, we can make it as 3 float. Mail float, processing float, clearing float. Mail float means this is physically sitting in the postal tract. Suppose my supplier or my customer is in Rajasthan. So what I'll do, I'll write a check and I have to mail it. I mean, I have to post it. So it takes 2 days, 3 days courier. So 3 days, that days it takes to deliver the check is called as mail float. Now, processing float means that supplier will take my check and or in my company they will take a check and they will sit and write in the recording books, and now my company's employee or his employees go to bank and has to drop the check. So the time it will take 1 day or 2 days. It is not that the courier got, they will run to the bank. Authorization steps will be there. They will take the check, someone has to record it, someone has to authorize it, someone has to go and drop it. So again it takes 1 day. So that is processing float. Next, clearing float is the time the bank takes. Who takes? Bank takes. Bank, if you drop a check, it is not that instantly they will debit or credit it. It takes some time, right? Check to process. Now it is 1 day. Within 1 day they will do it. But sometimes it might take 2 and 3 days also. So that is clearing float. So total is called as collection float or disbursement float. Clear with the float? Now how we can accelerate the cash inflow is we can create a logbox system. What is this logbox system? So I'm collecting the cash from my customers. Now country full I have customers, but the customer is not dropping the check, but it would take how many days? It would take many days. So I will create a logbox system. So in each postal office boxes, I'll create what? A box. So now I'll ask the customer, see, you don't send the check till Bangalore. next to your place only there is a lock box. You go and drop the check there. Enough. From there my bank will go and collect the check. Sorted. Now the bank will process the payment. It's always old methods, but still, yeah, we have to understand how the lockbox system work. How it works, we create, the company maintain a special post office boxes called lockbox in different location in the country. The invoices sent to the customer contain the address box of the lockbox. So the customer will go and drop the check in the lockbox. And so what I can do? I can reduce my collection float. So I can collect my payment as soon as possible. Clear? So the benefit of lockbox system is this. Calculate the amount of cash collected each day. Now, we'll do the cost benefit. So lockbox system doesn't come for free. What you have to do? You have to pay for that service, right? Now, why we are creating the lockbox system? To get cash sooner. When you get the cash sooner, you will invest somewhere and you will earn some interest. Correct? Agreed? So the lockbox cost, what benefit I'm getting? The interest I earned is a benefit. So we have to do what? Cost benefit analysis. So the benefit should be more than the cost. If the benefit is lesser than the cost, don't do the lockbox system. Let 4 days take time. So first what you will do that, calculate amount of cash collected each day. You will go and how to calculate the cost benefit analysis? Calculate how much you collect the cash each day. Multiply the number of days with the collection float will be reduced. By introducing the lockbox system, how many days you can reduce in the collection float, you check. 2. Multiply the increase in cash balance with the interest rate by which the company can earn. Then compare it. Example, JJF wholesale has an average collection delay of 8 days. How many days they are having right now? 8 days. Okay. Now they are able to reduce to 5 days. Reduce to, not by. Reduce to 5 days. So how many days they are able to reduce? 3 days. Second step is sorted. The cost of lockbox system is 32,000 per year. What is the cost? 32,000. Now, how many days they reduced? 3 days. What is the daily cash payment? We'll check. Average number of daily payment is 1000. So how many check will receive? 1000 checks will receive. Average size of payment is $400. So each day is how many check will receive? 1000. And each check value is how much? 400. So what is the average daily collection? 400,000. One check 1000 means in 4,000 into 400. $400,000 is 1 day collection. How many days collection? 1 day collection. How many days you will be able to reduce this?
3 days.
3 days. So 400 into 3. So average cash balance you can increase by how much? 1,200,000 in a year. In a year, how much you can increase? 1,200,000 cash you can collect fastly. So this amount you can invest and you can earn how much? 3%. So that will be how much? 36,000. Now you compare this. So what is the cost? 32. What is the benefit? 36. So will you invest in lockbox or not? Yes, you will invest because the cost benefit is more than the cost. Clear with this? Okay. Then now we'll start with discount period offered by the supplier. In the cash management, we'll understand this. So in the theory side, I already told you cost of not taking the discount. So this is a formula you can use to calculate the cost of not taking discount. So take down this formula, write it, and now we'll break this formula. Okay. You know how it is written, right? 2 by 10 net 30 means what? If you're paying within 10 days, you will get 2% discount. If not, you have to pay all the amount within 30 days. See, this is a formula of not taking the discount. First, we'll do right side of the formula, then we'll come to left side of the formula. Now we'll break this formula. In this formula, there are two elements. You see this discount percentage divided by 100% discount percentage. Okay, let me ask you one thing. So 100 2 by 10 into $100 you take. You are getting how much percentage discount? Suppose you are want to pay $100. You want to pay how much? 100. But if you get a discount, how much you will pay? 98. 98 will pay, correct. Now what is the interest you paid? Suppose if you are not taking the discount. 2. On what amount? No.
98.
On 98. So the percentage from 2, it will change to more than 2. That is called as the effective rate. They are telling 2, but we are missing more than 2. Because assume that this 98 we are taking as a loan. As what we have to assume? If I am paying today, I have to pay how much? 98. I am not paying to him within 10 days. That means you have to assume that you are taking how much loan from him? 98. And pay him 100. So you have to do 2 divided by 100 or 2 divided by 98. You have to do 2 divided by 98. That is this formula, which is converting the discount rate into effective discount rate. One half is clear. We'll come to the other half. This half is nothing but annualizing. This half is nothing but annualizing. 365 divided by discount period. Clear? Guys, clear with this? Easy as that. Now, I broke this 2 percentage. You borrow 2 divided by 90. So it made how much? 2.04 percentage. So the cost of not taking discount is not 2. It is 2.04 percentage. And then you sit and annualize this. When you sit and annualize, it will become how much? 37.2 percentage. 37.2 percentage. Clear with this? So you try this example only. Where it is? Yeah. You have to pay how much? Guys, you are getting 2, 10 and 100 is the amount. So we'll put this in the formula. What is the discount percentage? Yes, discount percentage is how much? 0.02. I mean, put everything in the decimal. 100 if I convert into decimal, how much it is? This is how much? 0.02 multiplied by. You keep this 360 in the question. They will give whether to use 360, 300 or 365. Don't worry about it. Whatever they are giving, that one you use in the formula. Total period of the payment. What is the total period? 30. Period for discounted payment. What is a discounted paid? 10 days. So how many days you are getting a buffer time? 20 days. If you are pay earlier, the 20 days you are borrowing money. Why I am 20 days borrowing money means because on 30th you don't have option. Either you take discount, either you don't take discount, you have to pay. So only the 20 days matter. So now we'll annualize this. First we'll do right side. 0.02 divided by 0.98. 0.020. Only this much? No. 0.024 you are not having?
0.020408.
0.0204. Correct. This one I took. Then this side is sorted. Now we'll come to this side. 360 divided by 20. Not 20 divided by 360. It is 360 because 20 divided by 360 you do. It is a portion you are taking. Now we are not making as a portion. Now if you want to make smaller, you do 20 divided by 360. But here annualizing means it's a bigger number. So it is 360 divided by 20. Now clear? Okay. Now you 360 divided by 20 is how much?
18.
18. So 18 multiplied by 0.204. How much it is?
0.3672.
And if you want to convert in percentage, 36 point. Sorted. Okay. Which is because of the decimal we are getting the little bit difference. And here I took 365. Whatever you take that. Okay. Now, suppose the bank is giving 8% annual interest. What you will do? Will you take the discount or you will not take the discount? Now, bank is offering me, I don't have $98 to pay. I don't have 98. So what I'll do? I'll go to and take the loan. Now, by taking a loan, you have to pay how much? 8% annual rate. Now tell me, will you take the discount or you will not take discount? Will take. Why? Because bank is giving for how much? 8%. But here how much I am saving? 37.2%. Obviously, I will take the discount. So I will go take a loan and I will take the discount. Okay. The cost of not taking the discount arises because the company has two options. It can pay the money early and take the discount and pay less money. Or it can wait until the full amount is due and pay it then, but pay more full amount. The difference between the amount paid early and the amount paid later can be considered as interest charge. Consider as interest charge. Clear with this? Sorted with the formula. This is accounts payable side. If you want to make account receivable side, same thing. The cost of giving the discount. Take it. That's it. Same formula. Everything is same. Here you are. There you are a giving person. Here you are taking person. Okay. Now, this one is sorted. Cash is sorted. Next we'll come to marketable securities. So marketable securities means your cash is, you have invested the cash in this funds, some money market funds and all you invested. So the primary objective is what? Liquidity and safety. In the investing in market, safety is not make to profit. Don't assume that. Marketable securities is not to make the profit. The marketable securities make to liquidity. I mean, if you keep the cash, what happens? The cash value is reducing. Now you have an option. Rather than keeping a cash, which is required, you have to put where? The marketable security. One is giving 10% return, the other is giving 8% return. As per the liquidity, where you will invest? The less riskier one. Because they are so liquid, they are classified as current asset because the primary objective is what? Liquidity and safety. Your principal value should not decrease. You cannot afford to lose this money. And secondary objective is what? Yield. First comes what? Safety. Second only comes the return. Here you are not investing to make the profit. Yeah, you want to make some return. But the primary objective is not that. My primary objective is liquidity and safety. Understand that? That is marketable securities. These are the few marketable securities. What and all it is? Money market security. Like a T-bill. T-bill means government bill. Treasury bill. It works as a zero coupon bond. Zero coupon bond means what? They will not pay interest on all. The face value you will get at the end, right? The face value will get at the end. So they will sell at discount. No interest and all is paid. Example, the T-bill is, face value of the T-bill is 100. Issue price will be 95. Issue price will be 95. Now how much you give? 95. But how much you will get back? $5 is the interest you want. So if you want to earn $20 on 1000 T-bill, you pay 980 for today. So you'll get how much? 20 divided by 980. That is the interest rate you earned. See, face value of the T-bill. How much is the face value? It was 1000, right? In the last example. Interest earned while T-bill is outstanding, 20. So the amount you have to pay today is how much? 80. The effective interest rate to calculate is how? Interest earned by the T-bill while it was outstanding. How much you earned? 20. Price discounted basis. So how much you pay now? 980. Now you this will get for this return. But this one you are earning within 60 days or 90 days. That means you have to, what you have to do? Annualize it. That's it. Now to annualize what you want. 360 divided by maturity date. Make it as 90 days maturity date.
4.05.
Why 4.20 divided by 980? You get it? Keep it aside, put it in the M plus, and then annualize it. 365 divided by 90.
Straight away can multiply 365 and divide 97.
That is what we are doing, right? We are multiplying with 365 and dividing by 90. You can do it. Oh, you are telling rather than putting in the M plus. Huh? At last that is the same, right? What is the 20 divided by 90 is how much?
0.
20 divided by 980, you are making 2.04 percentage you are making. Okay. Now multiplied by 360 divided by 90. 8.2. 365 divided by 90, you do 8.2. So this 90 is denominator, right? So it will be more. Clear with this? How to annualize? Anywhere if you see the annualize, use this format. First you calculated the effective interest rate and multiply with annualize. Next is what? Invest in the commercial paper. So commercial paper is a short-term security where you can invest your money, but this denomination is minimum $100,000. What is the denomination? Guys, 100. See, this might be asked in your MCQs and all. So go through the textbook once and read it properly, this theoretical part. Different types of, understand what is their features, what makes it different from others and all. So T-bills you can get for lower price, $1,000. But if you want commercial paper, the denomination is how much? $100,000. So like T-bills, it is also sold at discount. Like T-bills, it is also sold at discount. So you buy it on a sale, the company pays full face value at the maturity and the difference is your interest. Same the T-bill you did, right? The same one. Because you are taking one more risk, you would government backed T-bill or the issuing company are forced to pay high interest than what? High interest than the T-bill. That's it. Unlike T-bills, commercially, this will have no secondary market. So these are the few features you have to keep in mind. What is not having the secondary market? Commercial paper doesn't have secondary market. T-bill has. You can also buy the T-bill. In Indian Treasury bills and all you can buy. 90 days, 180 days, 360 days. Some, then it will become bonds and notes. 5 years, 30 years, 10 years and all you can. Under money market securities it will come this. This and all is money market security only. Rising capital. Under rising capital also again these things are discussed. So that is the reason I removed from there. Because this keep on repeating. Again it will come in the international finance also. If you buy 90 days commercial paper, you are effectively trapped. You must hold it for the full 90 days. You cannot sell it on 45 days. Why you cannot sell it? Because you don't have secondary market. Next is called as banker acceptance. You guys know what is banker acceptance is? How does it work? See, let me explain with an example. See, a US company doesn't trust a Brazilian company. I mean, import and export is there. See, you want to buy something from a place called like something you want to buy from Germany. Like a lot, bigger amount. So will you pay him like that only? Will you trust anyone? You haven't met him. And same way for him, who that German company, you want to send some machine. Will he trust you? No. Why he should trust you? Pavan garu, Andhra garu, Bagunnaru. Like he will not give that machine and all like that. Pavan will send his photo. See, I am good guy. He will tell no. You are not good guy. You are from Andhra. You are chana danger. He will tell means like how he will trust. That to Pavan, he will get afraid. Oh, he's some big gangster. So if we give that machine, tomorrow he will tell W ledu. You know what happened? So this who? So nane bhaypadunanu. So what happened? This US exporter, like as an Indian, what you do? You can get a help of a bank. Now you ask the bank now to settle this. So that bank will give what? A banker acceptance to the German company because they want to sell, right? So they, whenever they want, after 90 days, they can go and make the payment.
Minimum limit.
Not as that. Like, okay, you're asking like a rule in commercial paper. No, banker acceptance can be done. See, in India, many frauds happen by using this one material only. What happened is many banks did like this. They are standing as a banker acceptance for import and export. If if someone is defaulting, who will be responsible? Bank is responsible. So like that in India, many banks took the responsibility, and at last they defaulted. The person who took a loan defaulted. So at last this and all is outsiders, foreigners, right? They have to make the payment. They don't have any option. The bank paid. The bank paid thousands of crores. So many banks came to limelight, like 3,000 crores scams and all happened. Why? Because bank, in the sense, like, that's a human being is at last authorizing, right? It's not like a system. So human being is authorizing. So the person in the key officer did all this scam. So at last, who lost the money? That's a public bank. Public bank means whose money it is? Public's fund. So at last, the government has to take the hit. So government lost 3,000 crores. Who is paying at last? As our taxpayer, it is paying from our. So that is where the bank is so much regulated. You know that, right? Why the bank is so regulated? We have many applications and all is coming, and RBI is telling no, you close and go right now, because high regulated thing is what? Bank is very high regulated because these things happens. Okay, so banker acceptance not only happen in India, all other countries happen the banker acceptance. You see this example: US company want to export 500,000 worth of tractor to a Brazilian company. Who want to export this? US company want to export. So who will get the cash? US company will get the cash. So the US company doesn't trust this Brazilian company. So what they do? The Brazilian company doesn't trust the US company to send the money. Both will not trust. To solve this, that Brazilian company go to the massive internationally recognized bank. The bank officially accept the responsibility for the debt. For whose debt? The Brazilian debt. So they issue a banker acceptance which is legally guarantee. Who's guaranteeing? Bank is guaranteeing that $500,000 will be paid to the US exporter in 90 days. Who will tell this? The bank will tell to the US company, see, you send the goods, I'll pay you within 90 days. Now, because the US exporter trusts the bank, they'll send it. Suppose if SBI is coming and telling, you can trust it. Why you can trust it? Because it's a bank. Obviously, you will get your money. No need to worry. If that guy is also defaulting, who took the responsibility? Bank took. Obviously, the bank will pay. But the problem is when you will get the money? After 90 days. So what you will do? You will take this paper. You got the US exporter got this paper, right? You will take this paper and go to the secondary market and tell them, say, I have the banker acceptance. The bank is going to give after 90 days. Take this. So they will, 500,000 means they will sell for 490 or 480. 20,000 is a profit for the investor. Like this also, you can invest your marketable securities. Next is repos. Repos means like you repurchase agreement. You sell today and you promise them you will buy tomorrow. Let's say the bank is holding $10 million in US treasury bill. They said 10 million is actual cash for the weekend, but the amount will be received after 1 week or 2 weeks. So the bank sell the T-bill to the investor for 10 million, and when they come back Monday, they will again buy for 10 million 1,000. I mean, I have some asset, but I want money now. What I'll do, but I don't want to sell this asset also. I mean, don't want to sell this asset means like the investor, like it is like you can tell as like a mortgage only, kind of. See, I'm giving this asset to you. You take this asset. I'll come back on Monday and I will repurchase from you. So I sold this asset for how much? 100 rupees. So you will give 100. Now I'll come back on Monday. I will give 105 rupees and I'll purchase back from you. That's it. That is called as repurchase agreement. So these are money market instruments which you can invest the money. Clear with this money market, marketable securities. Now the point comes to whom? How much you should hold the cash. Now, holding a cash is a bad thing, correct? Holding a cash, a lot of cash is also a bad thing. But holding a less cash is also bad thing. Liquidity problem is there. So now we have to determine how much should be received each time the company converts marketable securities. You invested in marketable securities, right? Each time how much you have to sell. When you sell marketable securities, what you will get? You will get the cash. But when each time you are selling, is it free? Brokerage charge is there, right? That is need to be considered. The more you sell, more brokerage charge. 1 point. How much cash should be held by the company? With excess cash being held as a marketable securities. 2 things to be determined. Each time when you convert, how much is a conversion charge and how much you should hold the cash. So to solve this, we have a Baumol cash management model. So this Baumol cash management model will help you to calculate optimum amount of cash to receive every time it converts marketable securities. Each time you go and convert the marketable securities, right? How much you should take and go and convert is called. Who will help you to solve? Baumol cash model help you to solve. So this is a formula. OC is equal to 2 into B into T divided by I into square root. Okay. So OC means optimal level of current marketable securities which is going to convert into cash. B means fixed cost per transaction. Per transaction you are paying what? Fixed cost. Yes, bro, like kind of brokerage charges. T means total demand for cash for the period. What is the demand you have? How much money you require? I means interest for current marketable securities or opportunity cost of holding the cash. Now, before we break this, you know how the numerator and denominator works, correct? Now we'll think logically. Suppose if the market interest rate is increasing, what is increasing? Market interest rate is increasing. Where you invest in the market, whatever the return you are getting, it is increasing. So holding a cash now become more costlier because you are missing opportunity. So the denominator is there. Denominator is increasing. What happened to the value? Value will decrease. So you will convert little bit of cash. When you will convert little bit of cash? When the market rate is increasing. So as a mathematical also you solved, logical also you solved. And demand, when there is more demand, you have to take more cash. When the fixed cost per transaction is increasing, so what you will do? You will convert very lesser time. When you are converting very lesser time, you have to take more cash out. Example, I want 1 lakh. If I am taking 10 times, each time how much I will take? 10,000. But if I am taking 5 times, each time how much I have to take? 20,000. Increased, numerator increased, cash will increase. Sorted. That's it. But there are few assumptions. You have to consider this assumption, then only you will be able to do it. The demand for the cash is known. You know how much cash you want. You know what is the cost. You know the opportunity cost. These 3 things you know already. Based on this assumption, you are going and calculating. Okay. You see this example. The demand for the cash is how much? 5 lakh. Each time it's sell the security, it is charging how much? $10. Each time I am going and selling the securities, how much is the charge? $10. Interest rate is 4%. The opportunity cost of holding the cash is how much? 4%. Now we'll put this in the formula. 2 is constant. 2 into 10 into 500,000 divided by 0.04. And at last you have to press that square root.
Right?
Demand.
Demand, you will have to require.
I require.
You have to keep in the company.
Not 500 I have to keep. My annual demand is 500,000.
Means
I want 500,000 cash. I use 500,000 cash in 1 year for the operations. Okay. How much you got? 15,811. This is one answer you get, but it can be converted to multiple questions. So if 15,811 I am taking each time, how many times I have to take in a year? How to calculate that? Not divided by 12. See, I want how much in a year?
500,000.
500,000. Each time how much you are withdrawing? So what you have to do?
500,000.
That's it. Then you will get what? How many times? How many times it is? 30.
3.33.
34 times. Take it as. That is the time. See. Now next question. What is the brokerage charge you pay? 34 times you are withdrawing. Each time how much you have to pay?
10 rupees.
$10. Yeah, 10 rupees. Vaadu Andhrale unnaru. 10 rupees. Go to US. Okay. So how much it is? $340. Now, what is the average cash you hold? Average cash, how much you will hold? If I withdraw today, how much I will be having? 15,811. At end of the time, how much I will be having? 0. So the average cash what you can do? 15,811 divided by 2. That's it. Beginning minus ending. See, 30. So 32 times you are withdrawing. From one time to next time, Jan 1st I took money. Assume that I am withdrawing second time, Jan 15th. Jan 15th, how much will be your cash? You will have 0, right? Then only you are going and taking another time. So the average cash, how much you will hold? $7,000. Okay. 7, which means 15,811 divided by 2. Okay. Clear with this? So in this one question, don't assume this is the only formula will mug up and go. Multiple.
Average balance.
How to calculate the average? Beginning plus ending divided by 2. When I converted the cash, how much cash I will be having instantly? 15,811. Now the cash is over. I used all the cash. Now how much the cash I will be having? 0. So beginning plus ending is how much? 0 divided by 2. Then we will get average cash balance. So on this average cash balance, you have to calculate what? Opportunity cost. Because this is the cash you are holding. On an average, how much your cash is holding? 7,000. On that 7,000, you calculate 4%. That is cost what? That is an opportunity cost. Okay. The opportunity cost of holding the cash. Now this is another model, Miller or cash management model. This is easier. You have one lower limit, floor. You will tell my cash should not go below 10,000. Upper limit, my cash should not go up more than 55,000. And there is a target balance. We want how much? 25,000 usually we want. So what I'll do, when my cash is going below, I'll fund it. When the cash is going above, I will buy the securities. When I buy the securities, my cash balance drops. I'm putting in investment. But when the cash balance drops, I will sell the security and get the cash. So this is another model. Easy as that. Okay. Done with marketable securities. Clear? So in the marketable securities, understand this Bomol cash model. Clear with this? So in the regular class, we did with examples. So if you have the video access, you can watch that with multiple examples we did. The multiple questions I told, right? That multiple questions are done in it. How many times? What is the total cost? What is the average cash balance? What is the opportunity cost? What is the transaction cost you will incur? That we clearly explained with one random example we took, we did it. Next, left out is what? Account receivable and inventory. So, account receivable management. Guys, it's simple as that. Yeah, understand activity ratio in the section E, clear. It is not that section E you learnt you forget. They will ask the question in the point of view of section B also. How they will ask is, cost of not taking the discount is there, right? Cost of giving the discount they will ask. Operating cycle, cash cycle we learned, right? How you created the operating cycle and cash cycle? The day to make inventory to sale and sale into cash. How you got the days? We learnt already in section A. Number of days sales in receivable, days sales in inventory. Okay, so that days you take, apply it here, cash cycle, operating cycle is done. There you are just checking the ratio. Here you are using that ratio and taking the decision. Simple as that. Now, account receivable management also there is a problem. What? My money is stuck. Till this guy is paying, my money is stuck with him. One, administrative cost. This guy took the money. I have to send some guy to collect the cash. So a collection guy will go and collect. Collection person will go, right? Yeah. Next, bad debt. These are the three losses. These are the three cost of credit we are having. I mean, by giving the credit to the customer, these are the three costs. What are the costs? Opportunity cost because my money is tied up. Administrative cost because I have to run back behind him. Credit loss. Sometimes this guy will not give the money, so I will default it. So there is something called as credit policy. What is this credit policy? They will tell who will receive what amount. Suppose a person who is a regular customer of us will have more limit to purchase from me. But a new customer from Andhra Pavan is calling. So maki inta material kavali. So what I will do? Oh, మీరు కొత్త గారు మీకు credit లేదు. I will not give the credit, right? So I will tell him, so it's very doubt to credit. Then he will tell, I know Shiva, I am Shiva's friend, something. Oh, then I will give credit, but I will give only little bit because of the policy. Then I will tell, I send your PAN card, Aadhaar card, everything. I don't trust you because you are calling from Andhra. మీరు danger garu. What if he is not giving the money? So I will do. మాకు తెలుసు. So then what I will do? I will run the CIBIL score, everything check. Certain limit I will give to him. Then what happen if Pavan is doing a lot of business with me? Then I will tell, hey, మీరు అంత డేంజర్ లేదు, మీరు నైస్ గారు. So nice means what it is? Good what will? మంచి వాళ్ళు. మీరు బాలయ్య ఫ్యాన్, మంచి వాళ్ళు. నాను బాలయ్య ఫ్యాను. మీరు మీకు క్రెడిట్ ఇస్తాను. So I'll give credit. See why you don't know Balaya?
By Vaishali he got to know about
Not because of that. Money varies.
Yeah,
Like this, it will.
yes, I'm very big fan of Balaya. Hey, why like so that much power? If you see his movies, you'll get motivated. You'll break the chair there only. You trouble the trouble, trouble will trouble you. Correct. So that happens. See, that much power you have in the dialogue, right? So that much you will get. You go to the CMA exam, sit next to the computer. If you trouble the trouble will trouble you. Okay. So yeah, that happens. Try this. Then you will get troubled and then back. Yeah. So yeah, credit terms, credit policy, again, credit standard, credit scoring, these things and all is considered already settled. Each company will have their own credit policies. Now monitoring receivables is called as aging schedule. What is this aging schedule means? We'll sort the receivables 0 to 30 days, this many customers. 30 days to 60 days, this many. 60 to 90, 90 to 100. Why we are aging this is because then we'll understand the credit loss happen. The person who is want to pay more than 120 days, there are high chances he will not pay. The person who is in the credit period within 30 days, they might pay. So the loss is higher where the more the age is. Okay, that's it with the account. But in account receivable, do the question. It's not only like in the page I have finished it, but yeah, but in the question answer wise it's different. The cost of not taking the discount is there, right? The same concept. The cost of giving the discount you do. If I want to put in an example, what is the cost I'm incurring by giving the cash discount? That we'll calculate with the same annualizing factor. Then you will compare with the bank. Then if the bank interest rate is less, see, I will not give the discount. You give the money after 30 days only. I'll go and buy the loan from the bank. Because bank loan is if it is cheaper. Okay. That you will understand. Credit loss. Again, bad debt you have to understand. Bad debt, you know, right? Suppose if they're not paying the money. Opportunity cost, very important. Why opportunity cost very important is we did in many questions nothing. How many days my money is stuck with you? We'll take what? Average account receivable. How you will get average account receivable? Go to ARTR. That formula, ARTR formula. In that, what is the denominator? Average. Yeah, like account receivable is what? Your denominator. They will give the numerator. They will give the sales. They will give the ARTR. They will not give the average account receivable. So that you have to find. And on the account receivable, you have to calculate opportunity cost. They will give 8%, 4%. So that is on opportunity cost. Simple as that. See, the practicals is covered in the activity ratio. So what I am telling is, before you start working capital management, just go and check account receivable, see this activity ratios, come back and start this. So it will be going to be more easier before you start doing questions. So that will help. So what you can do, first learn section A, then come to B, then start E. C is the standalone one, you start C whenever it is required. Then again D and F is theoretical. So next is inventory management. Now when it comes to inventory, again we did for the Bomol cash model, right? The same way here we have something. But to understand that something, in the question they will not tell this is carrying cost, this is ordering cost. You have to understand what is carrying cost, what is ordering cost. Okay, so inventory, types of inventory. What are the three types of inventory we have? Finished goods, work in progress, raw materials. All this, if you are carrying anything, it incurs carrying cost. If you are having a finished goods, that also you have to carry. If you have raw materials, you have to carry. If it is in the work in progress, you have to carry. You need some space. The rent you are paying, the watchman you are keeping, the refrigerator, anything, that is a carrying cost. Insurance you pay. So we need to understand between these two lines, the need for enough, the danger of too much. What does it mean? We have to maintain an inventory as we need. We should not maintain too much. So one is what? Customer satisfaction. Goods are ready the moment the customer wants to buy. So customer will be happy. So you go to a shop, you're telling no, there is no goods. So next time will you go there? No, you will not go. Next, production continuity. Raw materials are ready, so the assembly lines never stop. Suppose if you don't have a raw material, what happens? Your assembly line stop, you have to simply pay for the labors. You have to simply pay the rent of the factory. Okay, next. Responsiveness, ability to handle the sudden demand. So you should keep the inventory this much. You're able to satisfy the customer, keep the production line running, respond to market demand. But you should not keep so much also. Money spent on storage and insurance handling, that is there. Cash cost is there. Opportunity cost, guys, this is a hidden cost. We can tell as a ghost cost. This cost never show up, but it is inside. Next, risk of obsolescence. When you carry more inventory, what happen? High chances it may get expired, spoil, break, or trend outdated it might happen. So you should not carry too much also. So we can categorize this different type of cost. One is what? Purchase cost. Purchase cost means what? The price you pay. Suppose I want 100 bottles, each bottle I am paying 9 rupees. So 900 rupees I will pay. So that is what? Purchase cost. But to bring that bottle into my place, I am paying something. That is also comes under a purchase cost only. Don't consider that is ordering cost. That is also comes up under what? Purchase cost only. Clear with this? Okay. Ordering cost means the process, purchase order, inspection, matching invoice, receiving report, updating accounting record, and all this comes under ordering cost. When you order the product will come. Receiving department is there, accounts department is there. Many department has to work. So then that will take an average cost, that is called as, each time when you order, the cost show up. That is called as ordering cost. Next is what? Carrying cost. So if you want to carry this inventory in the godown or something, you have to spend, like for the rent, insurance, security, taxes, spoilage and everything is considered as carrying cost. See, under the carrying cost, what will come? Opportunity cost. That opportunity cost, we can take it as a cost of capital, because that money you are getting from where? from the investors, and the investor demanding is what? WACC. They demand what? Cost of capital. That amount you are collecting from them, that amount is a cost, opportunity cost. Next is what? Stock out cost. What is the stock out cost means? Any idea? Loss of customer. The lifetime value of the customer, the profit you miss is called as stock out cost. Last, inventory shrinkage, theft, clerical errors might happen. Okay. Understood the category of cost in the inventory? These are few examples. Purchase cost means what? Unit price and freight charges. Carrying cost, storage, insurance, interest. Ordering cost, admin time and inspection. Stock out cost means lost sale or expedited freight. Expedited freight means you don't have the stock. One customer gave the bulk order. What you will do? You will call the supplier and tell, hey, I want bulk order as soon as possible. You will do that. Then he knows the demand. Usually he charges $9. Today you understood the demand. He tell, hey, you want order urgently, give me $11. That extra $2 why we are paying?
For speed up.
For speed up paying. The speed up happened because of what? Stock out. That comes under expedited freight. In the costing you learned, right? Suppose if this happening, this cost should be allocated in the part 1. There are few costs. Usually the cost, who does it order? Purchase department order. But sales department gave an urgent order. He didn't tell. No, if you give the urgent order, who will purchase? Purchasing department purchase, but they paid extra. But that amount, someone should be responsible, right? Is the purchasing department responsible for this? No. Sales department is responsible. So what we'll do with this cost? This cost is not allocated to purchase department. This cost is allocated to sales department. So under whose responsibility it will come? Sales department. Part 1. Then now you remember. So that is the expedited freight. Okay. How to do this and all? Take volume discount. You can get the discounts and all. Minimize average inventory. So carrying cost will go down. Minimize reducing frequency. Number of order go down. Stock out. Maintain the safety stock. Now the conflict is between these two. Ordering cost and carrying cost. If you order less, if you order very lesser number of time, you have to carry more. Correct? Because like, no, not carry less. I mean number of times if you order less, you have to purchase more at a time, right? I want 100 units means if I am purchasing 10 times means each time I will order 10 units. So I will carry only 10. But if I am ordering less means assume I am ordering only 5 times. So I have to, in the place of 10 times, you will carry 20. So carrying cost will go up. Opposite. Same way, if I want to carry more, my ordering cost will go down. Okay. That works opposite way. So that conflict is there. To get done with that conflict only, we are having what? EOQ. Now we'll come, still we have not reached. Now we need to understand some terms. Lead time and safety stock. What is the lead time means? It is a time you take to the order. It is a time between the ordering time to the goods delivered time. It is very important. This time is very important. So it is the time placing an order and receiving the goods is known as lead time. Next one, safety stock means it's a cushion, like every time the stock will be there. Minimum this will be there. Whatever happened, the stock should not go below the safety stock. It is for some unexpected events we are keeping this. It doesn't mean same bottle only we are keeping. Minimum 100 means new bottle will come and fill, but there will be 100 bottles. Okay. So what are the factors of the safety stock? We'll see. Lead time variability. Supplier usually take 5 days, but sometimes 10 days. In this case, what you have to do? Your safety stock you should increase. If you have a very reliable supplier, you have a backup plan and no need of that much safety stock. Risk is high, so you have to keep more safety stock. Demand variability. One is in the supplier side, one is the customer side. Sometimes you sell 10 units, sometimes you sell 50 units. You don't know, the demand variability is very volatile. So keep more safety stock to overcome this. Cost of stock out. If cost of stock out is very high, keep more safety stock. I mean, some luxury products and all is there, right? The cost of stock out is very high. If one customer goes out telling you, no, if we don't have the goods means you're missing so much huge profit. So in that case, what do you have to do? If the cost of stock out is high, you should maintain more safety stock. These are the three factors of the safety stock. Next, we'll calculate what reorder point. At what point you will reorder? Tell me, at what point will you reorder? When at which point you will reorder? When you reach safety stock?
When we know the demand,
Like,
next 8 months.
so I reach safety stock. Will I order in this place?
Before that itself.
Before that before where? When? So we learned lead time, right? The time it takes to deliver the product. Assume it is 5 days. 5 days. 5 days you take. And in each day, how much you are able to sell? In each day, how much you are able to sell? Assume the demand predicted is each day we are able to sell 10 units. So in 5 days, how much you are able to sell? 50 units. That 50 units should be there with you. Plus safety stock. At this point, you will reorder. Why I am telling is, once you reach the safety stock, right, you will get your new order. Again, level up will go. Because only 5 days, it takes time, right? 5 days, what you will do? You will extra use this 50, 50, 50, reach at the safety stock level. Now, at this point, what will happen? Your new goods will come and stock up will happen. We'll see this with the formula now. How to calculate the reorder point? Expected demand during the lead time. Within this lead time, what is the demand we have? How to calculate that? Average daily usage into average lead time in days. Example, if you use 20 units a day and you're taking how many days? 5 days. And your safety stock is 50 units. So first we'll calculate this expected demand. In each day your expected demand is 20 and it takes 5 days to deliver. So how much it should be? 100. Plus safety stock is 50. So 150 is what? Reorder point. Now when it reaches 150, you order. EOQ will order it. Then what happened? 5 days it takes, right? 20 will use in 5 days. So in next 5 days, what will be my stock now? 50. Because in 150, I would have used 100. Now where you reached? Safety stock you reached. It should not go below this. Then at this point, what will happen? Your new stock will come and you will get your new stock. That's it. Now this average inventory formula is this. Don't take that old formula beginning plus ending for average inventory. This is a formula for average inventory. See this formula? This one is used in the EOQ. EOQ, economic order quantity, we'll discuss in the next. This is the formula we use in the EOQ. See what is the difference here? Number of units order each time an order is placed. When I order units, right, that will be there. Plus safety stock. Why? Here, what is your ending inventory? What will be the ending inventory? Safety stock. That is the reason. Ending is what? Safety stock. So average this. Safety stock, don't do average. Why you are not doing average safety stock? Because it was always there. So this is always there. Plus whatever you are ordering that you are using. That you do average. This one is always there. So why we divide by 2? Because at the start of the cycle, you have full order. At the end of the cycle, you have 0. I'm not telling about safety stock, the normal order. So on average, you have half. Why add the safety stock? Because safety stock is treated as permanent float that never goes away. Clear with this?
Yes, number of units ordered each time. Not this place like order plus safety stock included.
No. Safety stock. See, now when I was ordering new units, this 50 is already there. I'm not ordering 150. 50 is already there. That not at use. That is there. This will not change. What matter? The 50 will be there. So when in the beginning also 50, ending was also 50. So average is how much? 50 only. 50 plus 50 divided by 2 is 50 only. So this 50 will be there. Don't change this. but you average only this,
Number of units ordered each time is 100. Then.
not 100. In this question, we have never discussed about how much we are ordering. Have we discussed how much we are ordering? No. When you will order, we discuss. Suppose we are ordering 1000 units. So 1000 divided by 2 plus safety stock. So it will be how much? 600. Assume the safety stock is 100. Each time I'll order 1000 units. So 500 plus 100. See, don't average like this. Okay. So this is separate. This box is separate. First you divide this. 1000 divided by 2, 500 plus 100, it is 6. This amount you will. In exam question, please pay attention to unit of time. If the usage is given in the week, but the lead time is in days, understand that. Convert into days. Okay. This is the example we use. See the example. Average daily usage is 20. Lead time is 10. Safety stock is 100. This is called as reorder point. And if company orders 15 days supply each time, how much I have to order? 15 days order I will do at a time. So 15 into each day, how much I will order? Each day, what is the consumption? 20. So I will order 300 units. Now what is my average inventory? If I want to calculate, 300 I will order, divide by 2 plus what is my safety stock? 100. So what is my average inventory? 150 plus 100. This is how you calculate. Now if you see the graph, first I will have 400. Once it reaches 300, 300 is what? Reorder point. I will reorder. But it takes how many days to get delivered? Not 15 days. 10 days. 15 days order I will do. 15 days item will be in my godown. But 10 days is the lead time. So in next 10 days, how much I would have used? I would have used 200 units. So at that point, what will happen? New stock will come. So 100 is already there. You order how much more? 300. Because we are ordering how much? 300. So 100 plus 300, how much it will have? 400. Again, it will come to 300. Then again, what you will do? Reorder. So again, it will reach here. Then again, it will get stopped. Okay. The ultimate one. The EOQ. EOQ is same as the BOMOL one, the formula and everything. But just what you are putting, just understand that's enough. So here, there is a conflict between what? Ordering cost and carrying cost. So when you order more small quantity, what happen? You end up paying more ordering cost. When you carry bulk, you end up holding more carrying cost. So these are the three factors incorporated in EOQ. The annual demand for the inventory, you know this, and it is constant. The cost of carrying of one unit of inventory. What it is? 1 unit of inventory for 1 year, which includes opportunity cost. All the cost is coming. In ordering, in carrying cost, what and all cost is there? There is all the cost. Insurance, rent, security, even cost of capital. Even the opportunity cost is there. Next, cost of placing an order. This is also known. Okay. Now, in the EOQ, this is a formula. EOQ is equal to 2 into A into D divided by K. A means what? Ordering cost. D means demand. K means carrying cost. Okay. Clear with this formula? Okay. Now we'll understand this. See, there are assumptions are there. If there is an example, yeah, we'll take a random example and we'll try to do this. Annual demand is 10,000 units. What is my annual demand? 10,000 units. I want annually. The cost of ordering each time is $50. The cost of ordering each time is $50. It's not in the units. Each time I order, right? This is the cost I'm getting. The cost of carrying one inventory is $4. The cost of carrying one inventory is how much? $4. 4. So now we'll put in the EOQ. 2 into 10,000 into, what is my ordering cost? 50 divided by 4. See, the new denominator should be like this, okay? What should be the denominator? The cost of carrying 1 unit. If they have given total, right, divided by number of units. So how much it is? Of 250 units I have to order?
250.
250 or 250?
250.
500. At last square root we will take. Clear? 2 into 10,000 into 50 divided by 4. So each time how much you should order? 500. 500 items you have to order. Now, what is my ordering cost? First understand how much time you will order. No, not at like 8, that is 50. How much time I will order? 10,000 divided by 500. So 20 times. I'll order 20 times. So 20 into 50. Each time I'll order, I'm incurring 50. So it is 1000 is what? Ordering cost. Now carrying cost is how much? Here there is no safety stock. So 0. How much each time I'm ordering? 500 divided by 2 plus 0. How much it is? 250 is my carrying cost. What is, I mean, not carrying cost. This is the average inventory. Average inventory is how much? 250. So 250 into 4 is the cost per inventory, right? So 250 into 4 is how much? 1000 is the carrying cost of the inventory. Clear with this? Any doubts on EOQ? Clear? See the relationship. Numerator direct relationship, denominator inverse relationship. Means if my demand and ordering cost is going up, what will go up? My EOQ units will go up. And if my carrying cost is increasing, what you will do? You will reduce the EOQ. You will order very less. Carrying cost is decreasing, you can order more. Next we have economic lot size. Reordering is different, EOQ is different. What does a reorder point says? What does it say? No.
When we have to.
When you have to order. EOQ says
How much?
how much. So there is an answer, right? When to order, how much to order. So reorder point will tell when. EOQ will tell how much. That's it. Economic lot size, it's same as the EOQ only. EOQ is used for the ordering purpose. Economic lot size is used for production purpose. How much we have to produce. That's it. Clear? So example, when each time we start doing the production, we have to clean the machine, set up the machine, set up the assembly line and all is there, right? So that will incur some cost. Same as the ordering cost, here we have a production start cost. Again, same formula you can use. See this, A batch setup cost, demand D divided by K, carrying cost of one finished goods. Okay. In inventory we have once again just in time. Traditional means a push system where we forecast the demand and do the production. But JIT means pull system where demand is not forecast. Customer give the order, then you start producing. What is the benefit of this? What is the benefit of JIT? Carrying cost will go down. But what will increase? Ordering cost will increase. So, but the problem with JIT is you want a very reliable supplier. If supplier is not a good guy or is not delivering product on time means, then your customer will get irritated. Your production will stop. So here we'll order very small deliveries. Instead of you order more, you order very less. Quality is non-negotiable. Why? When you start production, if the product is damaged, if the quality is compromised, what will happen? You will be not able to complete the product. Long-term partnership. So companies move away from shipping around for the lower price instead of sign the contract with highly reliable supplier. Clear? These are the advantage of JIT. Release capital. No longer to keep the debt stock. Reduce physical cost. Warehouse space will go down. Lower risk of obsolescence. Enhance quality. But the risk of JIT is what? What if there is a sudden spike in the demand? What if the supply chain disruption happen? You will be not getting the product soon. And if the demand is very high, JIT is a little bit problematic. This is done for predictable demand products and all is there, right? For they will do. The waiting period, like car manufacturing and all. You give them order, then they will tell a waiting period is 3 months or some months. Then you will go, and it's not like you go like this, you can buy the car and come back. Some cars, yeah, fine, but few cars and all you have to first only give the order and waiting period will be there. Yeah, this another topic is trade credit financing. The short-term finance, the three main short-term finances: trade credit, bank loan, and factoring of receivable. What is this trade credit means? Accounts payable. In the trade in the business we are getting the credit. So the trade credit is this. Again, here we learnt in the cash of not taking the discount rate, that same one. You see this again, 2%, 2 by 10 net 30, 2% discount. So it is annualized 37.4. So this one you keep in your mind. If cost of not taking discount is more than the cost of borrowing, then take the discount. I mean, if I'm not taking the cost, this is the cost. If I'm not taking the discount, this is the cost. And the bank is giving me at 10%. What you have to do? Go take the loan from the bank, take the discount. Because for 20 days he is charging how much? 10% means divide by 20 days. 10 divided by 365 into 20. That's it. For 20 days you will get the interest rate. This one is what? Not annualizing. This is proportionate part. Only for 20 days how much I am paying. But for annualize, what you do? Do ulta. Not you should not do 20 divided by 360. Here you should do 360 divided by 20. Shiva will get confused. This yesterday also he did same in the rights, doing ulta. You always want a number which is lesser than 1. Why? I don't know. Yesterday I am doing like what? Existing divided by new. Correct? Which is more than 1. He's telling no, it should not more than 1, it should lesser than 1. Because in part 1, everything is a proportionate. You never see the ratio or the denominator what we do, which is more than 1 is not there. Everything is lesser than 1. So that one is bringing in the part 2. Then he is doing again 0.2, 0.4. Why even decimal is tougher. To understand the decimal factor is tougher. I mean tougher in the sense you can't get an answer by seeing just a decimal factor. You want like a number. If it is a whole number, it is easy. Yesterday I told 5 rights are required to buy 1 share means no 0.2. Oh, come 0.2. Then again you at last what you have to do? You have to make it 5 only. 1 by 5 will do, 0.5 you will get again. So complication is there. So make it simple as that. See, if you learn like that only, right? Exam, that is a time consuming task. Making in a decimal and converting into the whole number is a time consuming. Convert in whole number directly. Why coming like this? Next is what? A bank loan. Either they can take trade credit or go for a bank and take a loan. See, there are few loan which is self-liquidating. You go take a loan, buy inventory, sell it and make an account receivable, get a cash, pay the loan. I mean, this and all is taken for short-term purpose. See, guys, working capital management topic is only for short-term purpose. It's not for more than 1 year loan. That's it. And this one is called as lean. Have you heard about word called lean? Lean.
Lean man.
That is lean. That
L-E-A-N.
L-E-A-N. This is lean. Have you ever? This is a banking term. suppose you have some assets and all you will keep in the bank mortgage. You take some loan, right? That asset is in a lien, which means it's freeze. You can't move that asset. But floating lien is different. You can move that asset, but the asset categories is freeze. Floating lien means I'll go and pledge my account receivable and inventory. Assume that I have pledged the classroom number of chairs. My job is to sell the chair. I go and pledged it. Then can't I do the sales? Because I have pledged. Suppose you have pledged your home. Can you sell the home without the bank intervention? No, because it's already on the bank mortgage. But floating lien means you are not pledging this particular chair. You are pledging what? The asset category. See, I'm telling I'm pledging this chair means it is not just this particular chair I'm pledging. I'm pledging what? The asset category I'm pledging. I can sell this chair and get a new chair. Suppose if I'm not able to make the payment, that guy will come, whatever the chairs are there, he will take and go. Same way account receivable also. I'll pledge what? Account receivable and take money. It's not like factoring. Factoring is different. Just pledging. Suppose if I'm not paying, what is the bank is having a power? Bank will go directly to my customer, say don't pay to him, pay to me. But it is not that particular customer. The asset category is pledging, that is called as floating lien. The category is pledged, not the particular asset is pledged. But when you are keeping a mortgage, home loan, car loan and all you take, right? Auto loan, you are pledging your vehicle or a home. You can't go to the bank and tell floating loan, idle loan. That is different. This is different. Yeah. The last in the interest rate is effective interest rate. 3 things will come in the effective interest rate. Either compensating balance, discount interest, compensating plus discount. Compensating balance means what? Like a minimum balance you take. What it is? Minimum balance. Now I took a loan of 1 lakh. Bank is telling keep 10,000. How much I got? 90. But bank will charge the interest on 1 lakh. That is compensating balance. Magic. So you're paying more interest or less interest now? More interest. Why? Because when 10,000 is calculated on 1 lakh, it is 10%. But 10,000 is calculated on 90,000, it is more than 10%. Agreed? Because here you are paying the same interest for lesser cash. So when the compensating balance, this is the effective interest rate. Then we have something called as discount interest rate. What is discount interest rate means? Discount interest rate means they gave a 1 lakh loan, but they gave 90,000 loan, but you have to pay back 1 lakh. There it is a compensating. Compensating, what they will do is they will give it to you, but you can't use. But discount means they will never give. You took a loan of 90, you pay back 1 lakh. Like this one I told, zero coupon bond. In zero coupon bond, how the investor will invest? They give 90, they will get back 100. Same here, now you are not an investor, you are a creditor. Think in the point of view of creditor. So here what you will do? You're gonna take 90, but you pay back 100. Simple as that. Okay. Give me a question. Give me a second. I'll take few questions and we'll solve this. It termed as usable cash. What it is? Usable cash. Now first we'll see for compensating balance. Okay. I took a loan of 1 lakh at 10% annually. But the bank asked me to keep 20,000. How much they gave? 20,000. So what is the interest you pay? I take a 1 lakh loan, but the bank told, hey, don't use 1 lakh, keep 20,000 in the bank account as a minimum balance. So how much you have to keep? 20. No, I told a term called usable cash. What is the usable cash here? What is the interest you pay? 10% of 1 lakh. Because the loan is on 1 lakh. So you have to pay the interest on 1 lakh. So now this is called as what? Effective interest rate. So what is the effective interest rate now?
0.125.
So effective interest rate is 12.5. Understood compensating balance? Now we'll go to the discounted balance. I mean, the second one, discounted interest. Here, I'm taking a loan of 1 lakh and paying 8% interest. Bank told 10% of the 10% is discounted. Bank told how much? 10%. Sorry, it's already given. So I took a loan of 1 lakh. It says 10% discounted. Okay. Now, how much you will get in the bank account? You will get 90. But you have to pay back how much? 100. So extra how much you are paying? So this is how you calculate what? Effective interest rate on the discount. The point is how much you get, how much you pay. How much you get, how much you pay extra. That's it. How much you get? Usable cash is how much? He gave 90. He didn't tell to keep any compensating balance. But he didn't give 1 lakh. There he gave 1 lakh and told to keep 20 in your bank account only. But here what he's doing? He never gives it to you. That is the difference. So how much it is?
11.1.
Okay. Next, third one is both. We take a loan of 1 lakh and it says 8% discounted. How much? 8% discounted. And 10% of face value you should keep as compensating. How much you should keep as a compensating? 10% of face value. So calculate effective interest rate. First we'll see what is the usable cash we'll get. What is the usable cash we'll get? You'll get how much? So first we'll remove that discounting balance. So 1,08,000 I have to keep as a what? 8% I have to discount it. Correct. So how much I will get? 8,000 I will not get. So I will get 92. Then again he says keep 10,000 as a compensating balance. So how much I can use now? How much I can use? He gave 1 lakh and told 8% discounted. So how much you will not get now? 1,08,000 you will not get. So how much you will get? 92. He gave 92. Then he told 10% of the face value keep in the bank account. What is the face value here? 1 lakh. 1 lakh's 10% you should keep 10,000. So 92 he gave, but you are able to use only how much? 82. But what is the interest you have to pay now? 8,000. Because the interest is 8,000. Because 8% discounted means that is the interest you pay. So now what is the effective interest rate?
$97.56.
97. 9.75. 9.75. Exhausted. Oh, hey, if I am writing also, like, you should understand, right? Because you yourself told. Calculation.
I told 8,000, 82,000.
Now let me make one thing. Assume the same loan. I'm taking a loan of 1 lakh. Yes, I'm taking a loan of 1 lakh for 6 months. How many months? 6 months. 8% discounted, 10% compensating balance on face amount. Okay, how much will I get the cash? Do you think how much I will get? First we'll sort the discounted part. In 1 lakh, how much percentage is discounted? 8%. But do you think they will minus 8,000? How much they will minus? 4. Why? Because I am taking loan for 6 months. The annualized interest rate is how much? 8. But will I have to pay him 8,000? I am taking a loan for only half month. So I will pay half. Which means 8% I will take. 8,000. How much you will keep the bank? 4%. Which is 4,000 they will keep. How much you will get now? 96 you will get. So yeah, 96 you will get. In 96, how much they told you to keep on the compensating balance? 10. That don't compromise. They told on the face amount you should keep 10,000, not annual or nothing. Compensating balance doesn't work. The minimum balance they should keep means you should keep the minimum balance. So how much you will have? 96 minus 10, you will have 86. What is the interest you pay here? 4,000, because discounted is 4,000. So 4 divided by 86, it is 9.3 percentage. Annualized. I mean, what is 4,000 divided by 86?
4.651.
4.651. This is 6-month interest rate, but whenever we speak about the interest rate, we have to annualize it. So here it is easy. 6 months means multiply by 2, it is 9. 4 plus 9, 9.6 something it will come. Huh? 9.3. Okay. Clear? That's it. So these are the 3 things we learned. One is what? Compensating balance. Second, loan with the discount. See the loan with discount formula. Interest on gross loan amount minus interest withheld. They will hold the interest. They will not give it to you. Third one is what? Compensating balance plus discounted interest. Okay. We'll finish this factoring and we'll leave. Tomorrow we'll start with corporate restructuring. Okay. So factoring means what? You're selling your account receivable to whom? Some bank and getting your money. What is account receivable? It's a current asset where my customer have to give money to me. That is account receivable. Now factoring receivables occur when owner sell the receivable to another party. So cash received from the factoring. So what and all he will charge is, he will charge factoring fee. What he will do? He will charge factoring fee. How he will charge? Based on the risk. Next, he's giving loan, right? It's kind of a loan. So he will charge interest also. Next, allowance for return. If all receivables are collected, the allowance will be then to pay to seller. Allowance means he will hold some amount. Suppose if he is not paying, or something called as the returns, sales return will happen. If the sales return has happened, will they pay for account receivable? No, right? So for these reasons, they will hold some money. Now, ways of factoring is what? With recourse and without recourse. Clear? So here something you can get back, something you can't. Go and tell this seller will, the factoring company will not come with you. Now advantage of factoring is what? May reduce the cost of collection by outsourcing this function. Doing a factoring, not only getting money is one point. One point is what? No need of administration cost now. The bank will go and collect. We no need to worry because we got our money from the bank. Bad debt may be eliminated. Suppose if the risk is taken by the bank, then bad debt is eliminated. You don't need to worry about the bad debt. Calculation is little bit confusing. So please focus here how it is calculated. Calculation of cash received in the factoring. Face value of account receivable. What it is? First line. Face value of, assume it is 1 lakh. What is account receivable? 1 lakh. And factoring fee is charged on which you see. The factoring fee is charged on face value. Assume the factoring fees is 4%. So how much you will pay? 4,000. Factors hold back for merchandise return, which is also on the face value. What it is? This is allowances. I told the amount withheld, right? That one you have to minus. Take it as 10%, so they will hold 10,000. So how much you will get?
86.
Fund available for estimated interest charge is how much? 86,000. Now still we have not yet charged the interest. Interest is charged on this amount. Don't go and charge the interest on 1 lakh. Interest should be charged when? Deposit to the seller account. Clear with this? Now whatever the interest rate they will. So these two things, which and all? Factor fee and allowances to be calculated on the face amount. Now what do you have? You have this, how much? 86, right? Now the interest is charged on that. So fund available into annual interest rate divided by 365 into estimated weighted average number of days. That is nothing but proration. We'll see with the calculation. So that interest amount you will minus it from here. This is a proceed to the seller. This is a exact amount they will get after deducting all this. And once that time period is done, they will get back their allowances. Whatever the amount withheld, they will get. We'll see with this example. The factor charges 4% fee plus 12% on all monies that are advanced to the seller. What and all is charging? 4%, 12% interest. And they are holding back how much? 7%. The receivable sold is 150. And the weighted average accumulated collection time is 120. So for how many days they are keeping this? 120. Say the bank is charging you how much? 12% interest rate. The 12% interest rate is annualized interest. But within how many days the bank will get their money back? Within 120. So do you need to pay entire 12%? No, only for these 120 days you pay it. So first we'll come till there. So first what it is? Face value. How much the amount they are holding back? 7%. So it is 10,500 minus. How much is the factor fee? 4%, 6,000. They will keep it. So the rest, how much you will get in your bank account? I mean, this is the amount which is used to charge what? Interest. No, 1,33,500 is this. And what is the interest he is charging?
12%.
So how much it is?
1620.
16.
6020.
So this is interest for the 1 year. But are you paying the interest for 1 year? How many days you are paying interest? For only 120 days. So divided by 365 into 120. You will get for?
5,267.
That's it. Based on their weight, we give the interest. See, whenever we tell as an annualized rate. But whenever we pay, will you pay for annual interest? You took only for 4 months. 120 days means 4 months. So you pay only 5,000. If you would have taken for the entire year, you paid 13,000 or say 16,000. But you paid only for. So you divide it and give it up. Clear with this? So guys, understand the factoring. You might get question and little bit confusing, right? So charges on the face value, interest is charged after deducting all the allowances and the factoring fee and everything. Maturity matching for the working capital. So what is this maturity matching is? Each type of asset is financed with maturity matching. I mean, short term by short term loan, long term by the. See, you can't buy the car for taking a loan for 3 months. Correct? Car is a fixed asset. So take a long term loan. Take a building for a long term loan. So for working capital management, this means the current asset should be usually be financed with current liability. So the current asset we have, right? Cash and inventories. This and all is financed by whom? Financed by current liabilities. Using the same approach, property, plant and equipment are financed with long-term capital. Clear with this? Tomorrow we'll start with corporate restructuring. So what are the 4 topics we cleared? Risk and return, long-term financial management, next raising capital, working capital management. Now we left with corporate restructuring. Again, it's completely theory. Then we have international finance. So don't miss out the international finance. Little bit is the ruler, like same as the options, little bit complicated. Then that's it. Then we start with section E. Okay, fine guys, thank you for the day. We'll see what is there in D and F, right? E we can cover it by tomorrow, but it's not that huge topic. First off, I'll try to cover the rest of the B. Second off, I'll try to cover E. D also, if you want, we can cover. Hardly take half an hour for the D, but F is the one which is take few time.